Ladies and gentlemen, our program will begin in 5 minutes. Ladies and gentlemen, our program is about to begin. Please welcome Bennett Richardson, General Manager and Global Head of Public Affairs at Semaphore.
Morning, everybody. Thank you all so much for being here this morning, and welcome to day 3 of the World Economy Summit and our conversations around AI and the next tech revolution. I'm Bennett Richardson, Semaphore's General Manager, Global Head of Public Affairs. Semaphore, as I hope you all are reading and well familiar with, we're an ambitious young news brand, just 2.5 years old, but we've already reached some great heights in terms of readership. We have nearly 1 million subscribers, reaching more than 5 million monthly readers around the world, with bureaus here in the U.S., in sub-Saharan Africa, and in the Gulf. And our vision, and hopefully you've seen it live and in person here at the summit this week, has really been to build the most transparent, intelligent, impartial, and global news product for leaders across the world, both in our journalism and in our live journalism, which we'll see a lot of today. It won't surprise any of you to hear that AI has made it into every track of the World Economy Summit this week. We're really excited to dive in specifically into conversation examining how artificial intelligence is radically transforming businesses, profound change happening, and leaders like the CEOs you'll hear from today are facing big questions around access, around implementation, and around governance. So a lot to dig into. You hear from a number of fascinating CEOs from different perches in the AI continuum and how they're tackling lots of different facets of AI adoption and transformation. We have a great partner in PwC helping us host this morning's track. And I'm thrilled to welcome up Kumar Krishnamurthy, the AI's, PwC's technology strategy leader, to kick things off with us. So, Kumar, welcome.
Thank you.
So, Kumar, as I was mentioning, AI has come up everywhere this week. And it's not just one conversation. It's about how industries are being reshaped. It's about how the ways that organizations themselves are made up is being reshaped. And leadership and the role of CEOs are being reshaped as well. You work with so many leaders and companies on their AI transformation. What's the biggest shift you're seeing in how businesses need to think about how they operate?
Yeah, great, and it's great to be here, and love the energy. I would put this under 3 topics, right? One is everybody's talking about AI, but what we are starting to see now is the fluency in AI is getting more to the ethos of an organization. So that's one shift we are seeing. And when I talk about fluency, it's not just saying, hey, I can open up ChatGPT and do a few things with AI, but it's really using AI to be part of how you think about your work, how you deliver the work, how you orchestrate the work, right? Now, that is opening the doors to change how capabilities are being threaded with AI, right? So in the last 2 years, as AI has somewhat gotten mainstream, we've seen a surge in individuals using AI, people kind of using AI, and it is, I'm sure the stats are out there, 60% usage in individual users of AI. But what is different now is now people are starting to say, how do I communicate with what I found with something the other part of the downstream part of the organization needs? And that capability threading and the capability orchestration is starting to get a little bit more dialogue around how do we bring this together. And the third thing, and this is the most interesting and complex challenge that we see that needs to still solve there. If you look at the Mag 7, and largely in the public utility sectors, you see the capital investment that is appropriate for a change of this scale starting to show up. But once you get outside of that and you look at the Fortune 1000 companies, even though if you look at the last 3 years, the capital investment has not caught up to it. So now how do you think about the capital that is required to drive this change and drive the shift? So if you've got the fluency, you know values, how and why value will be created. How do you drive that capability thread into a capital allocation that is more relevant to this economy?
Absolutely. I want to come back to the capital piece in a second. You mentioned scale a minute ago.
Yeah.
In so many industries, even in AI itself, we're seeing small players leapfrog incumbents thanks to AI. Is scale becoming more irrelevant?
No. So scale is shifting. So scale is not irrelevant, but we think this scale is shifting. Like traditionally, you used to define scale as, infrastructures, the biggest capital, the biggest power plants you had. Like you defined it in physical terms. Scale is now shifting from that to communities. How are you serving a network of communities? How are you driving an ecosystem of offering? How are you delivering value very differently, and you're able to drive the economies of scale to deliver the value differently. So the moats around scale are moving from just the physical components and not just accounting for the physical components, but also transitioning to the software components of what you own. And I think that is a slightly different mindset in how you think about scale. Now, interestingly, the threat of new entrants that you talked about is always there, right? We saw it in the e-commerce world, we saw it. But all those entrants eventually cause the change that we're all looking for here. And there are 2 ways those changes can happen. Those new entrants can become big scale players, right? Eventually that's what their aspiration is. And we are starting to see the presence of this in the Fortune 1000. there's a big need to drive the innovation in a very different way, right? So if you look at traditional Fortune 1000s, they can organically drive some of the innovation. But you can look at some of these upstarts as a way to kind of amplify your innovation as well. And what is interesting is we are starting to see that trend happening as well. So the scale players are looking at these startups as a way of amplifying their innovation. And it will break the deals winter we've been kind of going through to drive the change that we are looking at.
That's exciting. I mean, it's certainly an exciting, bullish outlook for M&A there to potentially bring in those AI startups and those accelerating forces into bigger companies.
It has to happen, right? Because if you look at the Mag 7 and the power and utilities, largely you're seeing them drive a big set of innovation. Then you have, just like we saw in the e-commerce world, you have these startups that are disruptors that are starting to show up. But really the change has to happen when these Fortune 1000 companies are innovating at scale. And there are two ways to innovate at scale. Once we solve the capital allocation, which we talked about, the two ways to solve innovation at scale is either you organically innovate, you can kind of like change the ethos of your organization to be more innovative, and I think a lot of the leadership is focused on that. Or you bring in innovation from the outside, which we are starting to see as we notice some of these acquisitions that are happening in the market.
Absolutely. Going back to moats, which you touched on with scale.
By the way, moats is not my term, that's Warren Buffett.
No, of course, of
right,
course.
So.
But I think there with competitive, like speed is becoming a real competitive advantage and a sort of a moat, especially, I mean, it's always true with startups, I suppose, but especially in AI. How do CEOs think about that challenge? Like, how do you move at the pace of AI innovation iteration without sacrificing your long-term corporate vision? It seems like those two things can kind of come in tension sometimes.
It can come in tensions, but they don't need to be necessarily the paradox that we have thought about in the past as well, right? Because speed has two components to it, right? One is doing things quicker, but also doing things in a transformative way, right? And both can get you the speed that you're looking for. And one of the advices we always share with our clients is, if you're talking about it, let me start slow. Let me think about looking at a targeted place where we can do a use case. That use case purgatory is never going to work because two things are happening. One is you're starting to say, I'll first do this, and then I'll do this, and then I'll do this. You're taking a very, very linear approach to how you're thinking about transformation. And really the power of this comes when, and this is really the power of AI, is when you orchestrate capability evolutions together. And speed can come by taking a much more parallel approach. I mean, the whole exponential growth in AI was because of that change in path in how you thought about speed in compute. Why not use that in how you transform your organizations?
That's a great point. I think part of that challenge and that balance that especially larger companies are trying to find is the temptation to try to do something bold, right? To try to really, how do we, bring something directly to customers?
You all want to hit the home run.
Exactly. Bring something directly to customers that's AI powered, that's industry leading. We've already seen in some different sectors how there can be stumbles in that kind of bold, fast, innovative approach. Like, how are you talking to CEOs today about balancing responsible execution with trying to get ahead of the pack and that bold innovation?
So the way we always, and sports analogies work in some contexts, and so I'm going to, and we use that a little bit. We think about this instead of a defensive and an offensive set of moves, right? So if you're planning for a ball game, you have to play the defense and the offense, right? And the defensive set of moves can be the things that are right in front of you, right? The procurement transformation, the HR transformation, the finance transformation. And those things give you, the fluency, right? People get much more comfortable with it. And when people get much more comfortable with it, they also start innovating. So that opens up the offensive set of moves that allow you to make that big step as well, right? So then you can start thinking about how do you hyper-personalize in your customer transformation? How do you do creative product management? We have a client that is the oil and gas industry, and they're thinking about, hey, from refining, what kind of products do I refine? And do I optimize my product portfolio a different way? That thought process didn't come because they started there, but it's because the organization became comfortable doing other things that gave them that benefits of the efficiency before they moved into that.
Absolutely. Well, and one way I feel like a lot of organizations are being comfortable with this is through that AI agent model.
Yeah.
I was talking with the chief AI officer of a big federal agency yesterday, and he was saying about he thinks about his AI executions as employees. Like I want to develop an expert in this. I want to develop a skilled operator in that. You know, that agent model can really reshape both the workforce and the operating model, as you were saying, can find some ways to really begin to see some of those efficiencies. Like that seems like a huge fundamental shift for companies that have just literally managed people for a long time. Like, what does it take to build that kind of symbiotic, agentic workforce? It seems intimidating to a lot of organizations.
Yeah. So first of all, people conflate agents with automation, right? And we spend a lot of time saying, if you just needed to automate, you had techniques in the past that you could do it. And agent, by its very nature, it can think, act, it has cognitive, it can make decisions. So when you start thinking about what the agentic model will do for you, it's you start taking components that allow you to work in a superhuman capabilities, right? So I'm making a comparison. But if you had a high productivity employee, how can you make the workforce operate in a very similar high? How do you create high-performing teams that are not wrestling to solve basic problems? And that's kind of where the agent really powers up and amplifies what you do. And I was in exchange with about 20 executives yesterday on this AI topic, and I had the funniest moment on agents, because one of the C-suite who reports to the CEO tells the CEO at one point of time saying, hey, why do you keep asking me for this information? Why don't you go figure this out yourself and create an agent? Because this is just not something, productive. And actually that allowed the CEO to work differently through an executive agent that the CEO now uses to get through some basic information that was important for them to run their jobs.
Absolutely, and I feel like that's such an important corner for leaders to turn, where you go from that initial experimentation, that initial, I'm going to ask ChatGPT a question and maybe I'm not perfectly satisfied with the results and move on. I was talking with a CEO yesterday, and they said their mantra around AI was no more prototypes.
No more prototypes.
They were just sick of having all of these little experiments happening all over the company, and they weren't being adopted at scale. How do leadership teams make that transition? Like, how do you go from letting 1,000 flowers bloom when it comes to all these experiments with AI? Like, how do you jump from that state, which is already a progress in many industries, but to really building a culture where that AI innovation can scale across departments, across levels?
So, and you raised this topic when we talked about agents, right? So as you think about even the agentic architecture, the way value is created is to threading the needle across the capabilities that you need to develop. And when we talk about capabilities, how do you deliver customer intimacy? So it's not about these individual agents or individual AI opportunities that you create, but how do you orchestrate it across a series of it? And I would think about this in terms of how we evolved when we went through the e-commerce and the mobile architecture, right? And as you can see from where we were in 2000 to where we are now, we really have a threaded way of how we view the world. And I think that's what organizations have to think about is how do you orchestrate the work of different agents as you get more AI fluent? How do you orchestrate the work of different AI agents to create a step change in enterprise? This is about driving a step change in enterprise performance. This is about driving a different way of delivering value. And you have to keep that in mind. It's not about incremental opportunities, but a step change in how you drive enterprise value.
Absolutely. Well, looking forward to hearing more about those step changes throughout the conversations this morning. Thank you so much, Kumar, for kicking things off with us.
Thanks.
Appreciate it. Thanks, everybody.
Thanks.
Appreciate it, sir. After you. All right, on with the show. Thanks, everyone.
Please welcome Michael Intrater, CEO of CoreWeave, and Reed Abrigati, Technology Editor at Semaphore.
Good. How are you? All right. So thank you so much for doing this. It's been like, about a month since the IPO, right before Liberation Day. Tough time to come onto the market. It was also, one of a lot of really tough questions. I checked the stock price yesterday. You're above the IPO price. Do you feel sort of vindicated after that rocky start?
No, I don't feel vindicated. I don't feel any of that. I feel like we took the company public for some very specific reasons, and we are bringing a new business model to the market, and the validity of that model is being debated every day in the stock price by a lot of people who don't have a ton of information or track record with the company yet. And by going public and bringing it into the public market, we're beginning the process of introducing the company to a new group of investors. And the vindication will be, 2 years from now, 5 years from now, when people understand what we're doing and have had experience with what we're doing. And at that point, folks will value the company as they see fit. And at that point, I think that will be the vindication. And I don't think vindication is even the right word for it. I think it's just really more of, it'll give folks an opportunity to express their interest in how we approach this business. I think about, and I kind of talk to the whole company about this, like we've been working on this model, building an astronomical amount of the infrastructure that's required for artificial intelligence to work, right? For the training, for the inference, all of those pieces. And when we talked to the private investors about what we were doing, it took us, a year with them to get them to understand what we were doing and why we were doing it, why it was appropriate to build a tech company this way and to finance it this way. And when we went to the lending community, the private lenders, that also took about a year, where we had to teach them about like what the technology was and why our business model made sense, and most importantly, why they were going to get their money back. And I just think that like it's really important for people to spend time with CoreWeave, to spend time with what we're doing, the role that we play in the space, the technology that we bring, how our balance sheet interacts with the success of the business, how that fuels how we kind of marry up our, accretive client contracts to specific debt blocks and kind of marry them up so that, it works.
Yeah, I mean, from my perspective out in the Valley covering tech, I talk to entrepreneurs all the time, and they just can't get enough tokens, right? The actual, the data that they're paying for when they use a cloud provider like CoreWeave, it's just not enough demand. So it's a kind of simple, when you think about it, it's a product that people can't get enough of and are willing to pay for. And yet, I think the market is still asking this question, like, is there any demand for this? Like, do people even want to buy this? How do you see that sort of disconnect?
Yeah, so you said that there isn't enough demand, and I promise you there isn't more than enough demand.
Sorry, I meant to say enough supply. That was a mistake.
The DeepSeek moment was informative, right? And my background is from the financial markets. I've run several hedge funds. I've built several hedge funds. And I've never seen an experience where there was as severe a dislocation with the interpretation of the financial market and the physical underlying infrastructure. drivers. So DeepSeek comes out, the financial markets go into abject panic, right? A massive dislocation kind of rattled the foundations of the AI trade. It rattled the foundations of technology, investment. It did all kinds of crazy stuff. And the only two things, so that's the financial side of the market, and then the only two things that happened on the compute side of the market, which is where I sit, was the first thing that happened is the price for spot computing, right? Which is just went through the roof, right? And that demand for that was probably driven more by people trying to get onto DeepSeek and try it and see what it does and how it works. But there was a massive run-up in that. And then the second piece of it was my phone blew up, where my clients, who are the people that are building these models, the people that are serving inference across the space, the only thing they wanted was, how do I get more infrastructure? How do I get it faster? How do we pull it in? How do we build bigger? When can we build bigger? And I'm just sitting there going, watching the market kind of lose its mind and struggling to reconcile that with what's going on. And I feel like that kind of asymmetric response right now exists throughout the market, right? Where, you know, somebody shows up and says, you know, one of the hyperscalers is shutting down 3 GPUs in a data center in northern Norway, and the market flips out. And they're missing the thematic power of more compute, sooner, more powerful, larger fabrics at gargantuan scale.
Well, so it's interesting you mentioned that, because it's one of the questions I have about CoreWeave. So you've locked in these long-term contracts, right? Which I understand makes a lot of sense. It creates stability. It probably helps with the lenders, right? But it also prevents you from, as the economics change, right? You get these huge spikes in demand. It also prevents some of the upside, right? You can't, you're locked in for a few years. Do you, if this is such a, if we're seeing this trajectory here and it's just gonna increase, have you sort of locked yourself in? Have you sort of put a ceiling on where you can go over the next few years?
So we don't look at it that way, right? Like, we look at it as we're building out this part of the business, which is structured in nature, because the primary driver for us is to get large, is to get to scale, is to get to the public markets, to become investment grade, to drive down our borrowing costs, to prepare the company to be able to compete after markets do what they do, which will be to allow the space to exit what has been a period of disequilibrium within the GPU computing infrastructure, right? ChatGPT came into existence, and there was this shock load that occurred that caused the entire computing market to be out of balance. That allowed a company like CoreWeave to emerge. What we are doing with that opportunity is we are focused on becoming as large as possible so that we have the momentum and scale and technology so that when this period of disequilibrium subsides, we are able to compress the spread between our borrowing costs and the borrowing costs of the hyperscalers, so that we will be able to effectively compete on the quality of our infrastructure, on the quality of the solutions that we provide with our software, in their ability to stand up and deliver infrastructure so much more effectively than anyone else.
When you have something like, you have a $12 billion deal with OpenAI, when something like the image generation thing happened, you got all these Studio Ghibli images, Sam Altman says, our GPUs are literally melting. What's happening inside your data centers?
Not melting. Yeah, look, when you get to the fundamental kind of value proposition of CoreWeave, what we have built is a specialized cloud that is built to deliver the data centers, the computing infrastructure, the software, to allow companies to run artificial intelligence in the most effective and performant configuration possible. So if they're melting GPUs, they're melting GPUs in suboptimal environments. We don't melt GPUs. We really have built from the ground up to deliver computing infrastructure to an enormous market that's growing at a staggering rate, what we consider to be the optimal solution, right? And the way we think about it is the hyperscalers that built their cloud infrastructure, the architecture of that was built 25 years ago, and they built a minivan, and that minivan is incredible, right? It allows you to store your photos, it allows you to serve SaaS applications, it allows you to do all these amazing things. You know, when I think about it like minivan, it's like get your kids to soccer practice, go to the supermarket, you know, get your roommate's mattress across town, whatever you're going to do, right? We didn't build that. What we did is we said, okay, first principles. Every single decision that we're going to make is going to be based on this new type of compute, this parallelized computing, which is a different approach to computing. It has fundamentally different requirements than what the cloud was built to do. And when you build something specifically to solve that problem, you build a Lamborghini. You build a speed vehicle that is capable of serving that in an incredibly effective way.
So you're using NVIDIA GPUs. They're a big investor. You mentioned the hyperscalers. They're building custom silicon, right? And their argument, like Amazon, for instance, AWS is arguing, we're going to vertically integrate with our Trainium 2, and that's going to be the most efficient way to run these models. And they'll take a CUDA, we won't get into the details of CUDA, but they'll take a model that can be ported over from CUDA, run on their chips. Are you saying that's not the right way to go?
So I think the way I think about it is really much more along the lines of there is currently a solution that is the solution that our clients are asking us to build. So we build the best solution for them.
And that's NVIDIA-based.
And that is the NVIDIA-based infrastructure. But the way that we have built our software stack, the way that we have architected, the way that we deliver compute, we're agnostic to what type of compute we do. The decisions that we made about how you deliver compute is different from the legacy cloud. What the GPUs underneath it is just a function of what is the client leading us to. And we are client-led. They are telling us this is the solution we want, this is the solution we build. And you know, to be fair, it's probably a bit self-selecting because you know, we're really good at building this infrastructure and bringing it online. We were the first ones to bring the H100s to market. We were the first ones to bring the H200s. We were the first ones to bring the GB200s. Like the software solutions that we have allow us to bring this infrastructure into enterprise scale delivery faster than anyone else. So we play an important role in the ecosystem by delivering that infrastructure as effectively as we do.
Mike and Trader, we're out of time. So many other questions. Fascinating company, and hopefully we'll talk more.
Hopefully.
Thank you.
Thank you. Thanks, guys.
Please welcome Bob Frenzel, Chairman, President, and CEO of Xcel Energy, and Tim McDonald, Climate and Energy Editor at Semaphore.
Good morning, everybody. Thank you so much for being with us. And Bob, thank you for joining us for this. Really happy to have you here. And we can't talk about tech without talking about energy and power. And it's kind of at the heart of all of these AI and data center questions. And really the big, could be a constraint for that industry. So I think what the utilities are doing is super interesting here. I mean, can you tell us, so you had your earnings, first quarter earnings yesterday. I think it was down just a little bit from the same period last year. I mean, is this a good time to be in the utilities business? I mean, how are things going for you guys now?
Yeah, thanks. First of all, thank you for having me. Thanks, Tim, for being here. It's great to follow Mike and CoreWeave when you talk about customers and how we think about our business. You know, at Xcel Energy, We're a rate-regulated electric and gas utility. We serve 8 states across the Midwest and the southwestern part of the United States. Incredibly capital-intensive business, and in a new state for us, which is a high-growth state, meaning, for a long time, energy demand in the United States, at least electricity demand in the United States, was sort of 0 to 1%, tracked a little bit less than GDP, now in a significant growth state. So you ask, is it a great time to be in the electric business? And I'd say absolutely. We are deploying capital, serving customers, and with whether it's re-onshoring, reshoring, manufacturing, or serving large manufacturing loads like AI data centers, or we serve the Southwest in the oil and gas business in the Delaware Basin. All of those are growth sectors and growth businesses for us.
What are some of the headwinds that you kind of see coming for you guys now? I mean, high interest rates may be a problem. How are you affected by the tariff situation?
Yeah, no, it's a great question. Look, we spend a lot of time thinking about cost of capital. We deploy probably $10 billion of capital a year. As an industry, we're probably $200 billion a year of capital deployment. So whether it's the cost of equity, which can go up because of uncertainty in the marketplace, whether it's the cost of debt, because credit spreads widen or the underlying treasury expands or the dollar weakens, all of those things affect how we spend our capital dollars, which ultimately makes its way into everybody's energy price. Whether you're a retail customer or a large industrial customer, the price of electricity is something that we're focused on making sure that we keep as affordable as possible to make sure that we can be an enabler of growth in the United States.
How are those like the spending plans and kind of growth plans affected by, by tariffs and the kind of trade situation? I mean, I don't know if that raises costs for you, steel becoming more expensive. I mean, all of these things.
Look, we didn't wake up on April 2nd or November 6th and think that we weren't going to be in some form of trade challenges. We've spent a lot of time over the last 3, 4, 5 years thinking about our global supply chain, whether it was driven by pandemic needs or otherwise. And we have, a lot of our capital, the majority of our capital program and equipment is all sourced domestically. I say all. Majority of it is sourced domestically. We do have, with certain exceptions, some international exposure. Steel and tariffs, yes, they can be impactful if they are sourced internationally, but we source most of stuff domestically for transformers, for lines, for towers, and things like that. Notably, the solar supply chain over the last 4 or 5 years has dramatically shifted out of China and majority either into Southeast Asia or into the United States. So we're mitigated on the solar side of the equation. And then sort of the last big asset category that we think about in terms of exposure to is really the battery side of the equation. Still largely a Chinese-dominated supply chain, though not exclusively. And we'd expect with tariff actions like we see that supply chain is also relatively fluid and dynamic and can relocate itself predominantly outside of China, maybe to Southeast Asia, maybe as far as the United States. If we had some tariff and trade certainty, I think you'd see more manufacturing come domestically.
And I think the battery situation is really interesting because that is very closely linked to your ability to deploy more renewables is kind of linked with the batteries and affordability of that. I mean, do you see that becoming a kind of headwind for renewables deployment?
Electricity storage has long been a goal of the industry to bring down. We keep a lot of electricity in backup forms of backup generation to make sure that when the sun shines, it gets hot, we have load swings, that we have generation to serve that. And batteries have long been a goal of the industry to sort of level out that need. It is an enabler of renewables because you don't always need the electricity when the wind blows and the sun shines and you want to store it. But storage is something we've been working on as an industry, and we've been thinking about as the holy grail for decades. We've gotten really advanced in lithium ion over the last half a decade or so, largely driven by the needs for electric vehicles. But the beauty of lithium ion is it's got a high energy density, and it's great for batteries and phones and cars. We actually don't need that kind of energy density on the grid. We have plenty of real estate to put batteries on, and we're actually working on a new technology. It's an iron oxide battery made by Form Energy that is domestically manufactured, is 100 hours in duration, and looks to be a great asset category for us as a company and electric companies across the world to really step into if we can make this technology work effectively.
Okay, on the other side of the generation equation, I mean, can you say a bit about your coal fleet? And President Trump had an executive order a couple of weeks ago looking to kind of throw a lifeline to coal-fired power plants and coal mining. And I mean, is the coal industry coming back? Or are you guys extending the life of any coal plants? Or how do you see that working?
Look, I think the executive orders recognize the fact that the country needs as much electricity as we can get right now. We're in a growth period, and we're looking to solve that as quickly as possible on behalf of our customers. We serve, all the hyperscaler data centers. We serve guys like CoreWeave, Mike was on in front of me, as customers in very large electric loads and growing with a almost insatiable demand. I think the coal EOs are a short-term potential benefit. Longer term, these are 50, 60-year-old assets anyway, and we've got newer forms of generation and more cost-effective forms of generation. We have wind, we have solar, we have storage. Long term, we'd like to see more nuclear energy deployed in the United States. I'm a recovering nuclear engineer and an ex-Navy guy, and I'd like to see more nuclear to replace the existing fleet, which serves almost 20% of our energy today with always available carbon-free energy. And then we've got all this great new technology in nuclear under development, which is probably 5 to 10 years away. So this could serve as a bridge to that, but in the short term, we're going to see more gas, more wind, and more solar because it's available. And in the long term, I think you're going to see new forms of technology, nuclear, geothermal, maybe some storage and sequestration tech, and a continued push into wind and solar.
But not a big renaissance for coal coming from what you can tell.
No, I think we have 40 gigawatts of coal scheduled to shut down in the next half a decade, and we need almost 400 gigawatts of generation. So it scratches the surface, and for a short period of time until we can get, the supply chains for either natural gas or wind or solar or storage ramped up to meet the demand that we see on the horizon.
Can you just unpack that a little? Well, just a little bit in terms of when you think about the load that you are anticipating. What are the sort of fastest, most effective forms of generation that you can bring on? And I guess just to level set too, the president has described that we're in an energy emergency. There's sometimes sort of sense of panic around how we're going to provide the energy for data centers. I mean, how freaked out are you about the load growth that we see coming? How worried should we be about that?
Well, I'd start with the fact that the grid is very stable and capable. Our generation fleet is very capable today to meet the needs of today. We see growth on the horizon. We talk about big numbers with data center clients, but it is a phase-in even for them to build out. We've got a chip supply chain need that has to match up. So matching electricity and the capabilities of the hyperscalers at the same time is really critical. So we stay very close to our customers. Long term, we've got to build the infrastructure in the United States to serve this load. I think that means we need to move quickly on transmission build-out. We need to move quickly on generation build-out. And it comes back to a bit of this issue of we haven't been as an industry designed for growth for some period of time, which means that our states and our regulators also haven't been designed for growth. So you see things coming out of the administration like acceleration of siting and permitting at the federal level, legislation to have NEPA and ESA and Waters of the U.S. reforms to accelerate our ability to build more efficiently and faster. I think all of that stuff is necessary. We need to do those same things at a state level as well, because it's not just a federal challenge, sometimes it's a state challenge. And we have not been great builders of infrastructure in this country for 2 or 3 decades. We've got to find a way to move expeditiously and build infrastructure, protecting the planet, protecting our people, but building infrastructure more efficiently, and it will come cost effectively if we can do it quicker.
And you and I had also talked about the link to immigration policy here and the sort of workforce that's going to be needed for all of that. Is labor shortage something that you worry about, and how do you solve for that?
Again, we didn't wake up to a labor shortage problem, and we've been working with high school, STEM education, bargaining unit employees, federal government, state and government to make sure that we've got the workforce of the future. But we do have a shortage of skilled labor. We're seeing challenges in getting construction projects done, whether it's craft labor on concrete and steel, or it's technical labor on building generation turbines and transmission towers. All of that the demand that's being placed by my industry as well as the hyperscaler industry on the trades and the talent to get stuff built is putting upward pressure on the cost and the timelines to get infrastructure built. So I think we need to have a very thoughtful policy on immigration. We need a very thoughtful policy on training, trades, and tradecraft. And we work at the high school level and as low as 8th grade trying to attract people to come into the unions, come into the tradecraft, and come work for a company like ours or work for a partner of ours, a vendor of ours, who's going to build infrastructure on our behalf.
Mm-hmm, yeah. And then, Bob, you guys had some litigation related to wildfires in Texas and Colorado. Can you bring us up to speed on that? And I guess what I'm really interested in is a lot of utilities have been affected by natural disasters and wildfires. I mean, what do power companies need to be doing at this stage to protect their businesses from these sort of climate-related disasters in the future?
Yeah, I think it's twofold. You know, we talk about wildfires, you know, that's a national problem in search of a national solution, but we've been dealing with natural disasters in our industry, hurricanes, tornadoes, winter storms. We learn about derechos these days and things that no one ever knew about before. They're happening with more frequency and more volatility, which from my perspective means that we got to look at our infrastructure. We have to harden the infrastructure of the United States. I mean, it used to be when, you know, we built the system 50, 60 years ago in the most cost-effective way possible. And when a power pole fell over, you would call us as a customer and say, my power is out, and we'd come out and find the pole that went down and we'd fix it. Well, today when a power pole goes over, it starts a fire and burns, you know, 100,000 acres and 1,000 structures and other real catastrophic activities. And so we've got to build a more hardened and more intelligent grid of the future and do that in partnership with our states, with our customers. And it comes with, we also have to watch out for, again, I talked about cost of capital at the outset. You know, these things come with lawsuits. Lawsuits cause risk and cost of capital to go up. And in in a capital intensive business, we are hyper-focused on our cost of capital. And so making sure that we can mitigate risk as an industry, and there's a role for the federal government there's a role for state governments to play in mitigating some of the risk that happens from this very public good that we provide.
Yeah. So no problem. You got wildfires, labor shortage, rising costs for everything, need to power all the data centers, so totally easy job that you have going forward. Well, we're going to be watching all of that very closely, Bob, so thank you very much for your comments here. Really interesting, and best of luck with all of that going forward.
Thanks, Tim. Thanks, everybody.
Yeah, thank you. Thank you.
Please welcome Glenn D. Fogel, CEO and President of Booking Holdings, Inc., and Justin B. Smith, co-founder and CEO of Semaphore.
Good morning, everybody. So, anybody planning a vacation, sick of your travel agent, use your phone a lot? Anybody? No.
One hand.
One hand. Anyway, it's really, really exciting to welcome Glenn Fogel, the CEO of Booking Holdings. Booking.com is, of course, their principal product. It is one of these. If you're a sort of a fan of business and how companies evolve and innovation, it is really one of the great stories. I recently was at a lunch with Glenn in New York City with a gentleman called Steve Ratner, who's kind of a legendary investor. And he sat with Glenn, and afterwards Steve Ratner said, "Oh my God, that company went from this to this." So what did he mean when he was like, "Oh my God"? What was he? Well, you had the conversation.
Yeah,
I think he was talking about money.
Yeah, he was. So I've been in the company now 25 years. So 2000, and people are old enough to remember that was the .com boom time. But of course, then the .com collapse, and our stock was down to, on a reverse split, $6 a share, and we've gone from $6 a share to yesterday 4,800. So that's 800 times.
Oh my goodness!
And that's over a 30% compound annual growth rate each year for a quarter of a century. So a market cap of 160 billion approximately.
Oh my goodness!
So and it's and it's interesting because Steve's a brilliant guy.
It randomly coincided with you joining the company, right?
It's one of those things where correlation does not mean causation, but I'll take part of it. Okay. How about that? I'll take part of it.
That's amazing. And what is it, just to sort of tease out a bit, what is the the heart of the Booking.com sort of idea or differentiation? What has driven that incredible growth?
So what it is, and this is what the story of the last 25 years, is technology. Technology enabling us all to do things better, faster, easier, efficiency. And it's interesting because you mentioned in your little intro, you're talking about people who've given up on their, offline travel agent to do it online, doing it digitally. And you look at that change. I just had to look at some statistics. 70% reduction in the number of human travel agents since 2000 to 2021 is the stat I saw. And that's really interesting because that's great for shareholders, it's great for productivity, it's great for the bottom line. But the question is, so what are those people doing now who used to be travel agents? And that's kind of the story right now that I think a lot of people are wondering about with AI, generative AI. Things are accelerating in terms of the ability to do things more efficiently, but that efficiency, that changeover is also going to have incredible ramifications for our society. I'm not sure how many people really recognize how fast this is happening.
Well, talk about your own company. Presumably you've been using technology to automate as much as possible, to manage your cost structure.
Yeah.
Has your headcount grown significantly across these years, or has that been maybe a source of your profitability?
Well, it has, but it's different ways. So we have, of course, we're hiring more people who are experts in generative AI, which is fairly new. Whereas people, here's a thing that we're just looking at. So when we first started out, we operate in over 200 countries and territories, which is interesting because there's only about 180 countries in the UN, but we include things like, Puerto Rico, we count separately so we can build up the number higher. But we do over 40 languages. And back in the day, in 2001, 2002, 2005, we had an incredible number of human translation people around the world, putting into these 40 different languages, all the content, description of a hotel. You want to see it not just in English, but have people in India, Hindi, or whatever part of the world. And then though, technology comes in, and you start being able to do it with machine language translations. It's not as good as humans, but you don't need quite as many because now the humans are more like checking it and making it a little bit better, better, better. Well, nowadays, you don't need a human. You can make translation better than humans can do pretty much. So what happened to all those people? Those people don't work with us anymore, but we have a lot more technologists. So for us, we have about 25,000 employees around the world. But I'll tell you, it's going to be a very interesting thing. I go away from my industry, I go to other industries. I go to things like, is anybody taking a Waymo taxi? Anybody here? Okay, good, okay. Now obviously that technology is going to be really good for trucking. You know how many people are commercial drivers, make a living driving a truck in the United States? Anybody know that number? The number is 3 million approximately. 3 million people, okay? Now add on to that, how many millions of people work for Uber or Lyft? Then how many people add on are driving something for DoorDash? All of those jobs are extremely, not at risk, will be going away, okay? That's obvious. You don't need to be a genius or have this incredible, crystal ball. You were in the Waymo. You know that this is not far away. Or maybe you'll see a drone delivery instead of a DoorDash deliverer. So now we're talking millions of jobs, millions. What is going to happen? And we've seen this before, obviously. You and I we know this.
Does a company have any responsibility for this sort of moral quandary, or is it just the government's problem and the economy's problem?
Well, I'd say it's interesting about that because in today's market economy, even if I felt it is our responsibility, I cannot do something because my competitors aren't doing it. Yeah. So we end up with a difference between the companies and the shareholders. They're not going to say, oh, Glenn, you're doing good work. It's very nice. You're helping out society. They're going to say, your return is not nearly what your competitors is, so please, we're going to replace you with someone else. So that's why you really do need a government to put out the rules, the guardrails, that we all play by the same rules. But here's the thing, we've seen these changes before in technology, right? Everybody understands the story of the Luddites in northern England and the wool, the weaving, and they went rioting and all that. We know that story. And we know where America went from rural to urban, but that took a lot of time. Now we're having this time in a very, very short number of years. And that, you have a societal thing where things can break. So what we need, I absolutely believe, we need leadership at the very top levels to understand how can we come up with ways to make this change, which is not stoppable. You cannot stop this technological change, but make it so that we have a
That's a
softening.
public sector job.
It's absolutely.
It's a public sector job. So just a quick diversion. You're an incredibly competitive business. It's a little. It reminds me of the news business a bit. And the switching costs are virtually zero for a customer.
Totally.
We can just
Can
flip
you say
between.
this to Brussels, by the way, when you have a chance? Because they called us, they say we're a dominant player.
You had the
Please.
EU, the entire EU sort of finance ministry was here yesterday. You missed them. But see,
Don't get me
and
started.
we wanted you to come for 2 days. But
I would have loved to have had another conversation with them.
Next year. Can I
year.
sign you up? Okay, good. So I go on Booking.com, and I use it a lot when I started Semaphore because I no longer had 2 assistants, and I was working out of my kitchen, and I was planning my business trips. It's just better. I mean, it's a bit like that Amazon feeling when you're just like click and it's all done, and you just feel this sort of lightness.
It's not even done. It shows up in 2 hours.
Yeah, it's amazing. But so as the chief product officer, in addition to the CEO, which I assume that you take that mantle as well, what is the magic that some companies are able to accomplish in that user experience? Is it technology? Is it design? Is it people? What is it?
Yeah, it's all of those things. It's having a vision and then trying to execute and make it happen. So I believe in our story is that the way you're doing travel right now is incredibly frustrating. I know that because I travel too, and it's a real frustrating experience many times. And you think, why can't this be a better way? And it can be a better way. And my vision is that you have in your phone, you have essentially the equivalent of a human travel agent who is always aware of what your needs, wants, desires are, and is always looking out for you. I mean, you think, when you're on a holiday or a vacation with your family and you're in a city, I mean, why aren't you getting offers coming to you saying, hi, you got the 2 kids there. Do you know there's this great museum kids would love? It's 3 blocks down the thing, and we can give you a great discount. Do you ever get that? Of course not yet. But that is something that we're going to do. Or even more so, you're going to Amsterdam. Okay, everybody in Amsterdam likes to take the canal trip. Everybody does that. Everybody pretty much also goes to the Rijksmuseum, great museum, okay? We get you those tickets, of course we can do that. But what's more important is you got the tickets for the canal boat on Thursday. You got the museum on Friday. It's Tuesday. Okay, now the weather forecast, though, we know, everybody can easy know it, but we know what the weather is, and we make a change for you, and we tell you, we say, hey, it's gonna rain on your canal boat, but it's gonna be sunny on the day that you're gonna go to the museum. Why don't we switch this for you? Just press, click, and it's all done for you. That's the type of advice, that's what you want, and much more so. How many times you get the little notice saying, your plane is delayed 3 hours? That's not very helpful, okay? That's really not helpful when you're already at the airport. What would be helpful is that it's going to be delayed 3 hours, but we can get you on another flight of a different carrier, because the carrier that you're delayed, they're not going to be offering up to go on to the other one, right? We can switch that for you, and it will only be an extra $25.
But Glenn, those are amazing visions.
Yes.
How do you make them a reality? Is it like talent business? Is it like is there like a developer that does it, or is it like some amazing designer, or is it a strategist?
It's being able to get the 25,000 people in our company excited to make it happen. I haven't coded for a living since 1985, okay? And I wouldn't even know how or what to do now, okay? I can't do that part. What I can do, and my sole real job, my biggest job is the idea and then making people enthusiastic that they will go out and take that hill today. And that's what we're doing. But the thing
So it's a cultural thing. Yeah?
It absolutely, culture, right? Doesn't culture eat strategies and how it works?
Yes. So I want to switch gears a bit. Ken Griffin, who's one of the co-chairs of the World Economy Summit, was sitting in that chair 2 days ago. And we were talking about the global economic situation, the policy shifts of the Trump administration, and obviously the shock of these larger tariffs. He argued he thought the tariffs were obviously excessive and problematic, but he actually argued something different. He felt like the most dangerous thing about the recent policy choices actually was the tarnishing of brand America. This idea that America is a notion, it's a concept that is given us so many benefits and so much value. People dream of America as this place that they trust, that they can do business in, that they want to study in, the best universities, and that all these different moves are really, really potentially, he didn't say irreversible, but really, really setting that back. You're in 200 countries. What's your perspective on that?
No, I mean, we saw the numbers come out very recently from our government about the inbound people in the month of March, and there certainly has been some countries, people there are not coming to the U.S. If you look at the numbers from 2019 and then compared to 2024, travel industry globally is up, yet the number of people who are visiting the U.S. is actually down from what it was in 2019 when you look at 2024. And that actually creates a deficit for us in terms of travel. We have more outbound people than inbound. Of course, when you look at a balance of trade, you see that when we are sending people, when we get people to come in, that's like an export. Okay, that's how the money works. It's pretty easy. I think you all understand that. So we want more people to come in for our economy than we want people going out and spending the money in France. And that's not what's happening. Now, what are the reasons for that? Certainly, one of the things is I think Ken was right in terms of the brand has been tarnished for sure, absolutely, because I'm there and I hear it. People say, I don't want to go to the U.S. right now. For our business, that's okay, though, because we are so international and people don't want to come to the U.S., they're going to go somewhere else.
Maybe people want to leave the U.S. too.
We're talking holidays, 2-8 things. But the issue really is, think about the things we're not doing when compared to other countries. You know, other countries have a minister of tourism. We don't have somebody that's their sole job. We have somebody, 2 levels down in commerce now, which still hasn't been funded. Think about why somebody doesn't come here. Well, if you go to JFK and you're in a 4-hour line just to enter the country, when you go back home to your home country and they say, how was your trip to America? And they will say, it sucked. We got there, it was 4 hours lined up, and oh my God, that's not good. And every single person in that line would have paid $25 more to reduce it to just 10 minutes. They would have paid it. So if we just have the way to do that. We have big things coming up soon for America. We have the Olympics coming. We got the World Cup coming. Are we going to show a good side? Are we going to do a thing and make you, hey, coming to America is great and help build that? That's good for our 10% of jobs in America relate to the travel and hospitality industry, okay? Why would we want to do anything that would hurt that? We want to build that up. That's really important, and I really hope that people who have the power to make it better are able to start doing that.
We just have a very short time left, but what are your thoughts? A lot of the CEOs here talked about leadership in a crisis. Obviously, the changes that we've seen in policies, the pause that people are making. What are your thoughts generally from your career on leading through a crisis?
Well, part of it is recognizing that all things do pass. It's don't get too panicked. I mean, we've been through everything over these 25 years. And obviously, the dot-com implosion was a horrific thing, and then we ended up coming back, but you ended up with a great financial crisis. We had volcano in Iceland, shut down travel in Europe for 10 days. We've had tsunamis. We've had wars. The Russian invasion of Ukraine was the night after we did our earnings announcement, and that made a big change because we had been previously the #1 player in Russia. These things happen over and over again. So you recognize the pattern that, yes, it's going to be very hard, and you've got to deal with it immediately and make it better. But you recognize that in the long run, things will work out okay if you maintain a level, thought in your mind. Don't panic. And I'll tell you right now, I am more optimistic than I've ever been about the long term. This incredible Cambrian explosion of new things coming from Gen AI. I mean, all the new tools, all the new things, it's going to be fantastic in all parts of every industry and everything. It's going to be great. That being said, we have to make sure that we have the right guardrails, we do the right things in terms of safety, and in addition, we understand what the consequences of these new ways to do things, what that does to our society in terms of people's jobs.
All right. Well, with that optimistic note, thank you so much, Glenn. Please join me in thanking Glenn.
Please welcome Adina Friedman, Chair and CEO of NASDAQ, and Liz Hoffman, Business and Finance Editor at Semaphore.
Morning, Adina.
Good morning. How are you?
I'm great. Thanks for joining us. So we've heard a lot over the last couple of days about what the economic policies right now have meant and will mean for the economy. What has it looked like from your seat in markets?
Well, I think the investors have had to absorb a lot of news and a lot of changing news. So you're seeing that obviously manifest itself in the markets. It has been an incredibly active period of time in the markets. We just had earnings yesterday, but we had our thank you. We had record volumes within our markets in the first quarter, and then in the first 10 days of April, we had 5 of the top 6 trading days in equities, 4 of the top 6 trading days in options ever in the history of markets. And on our peak day, we also really evaluate message traffic because you have to look at how many messages are we managing through our systems. And we had 550 billion messages flow through our system.
And what are those? Buy, sell?
So they're all the orders. So you think about all the orders that come in, all the orders we send out, all of the messages we come in, so orders turning into trades, and then also all the message traffic we send out to make sure that all the market data feeds are working. But what's happening there is that in equities, you have about 4,000 listed companies in the United States. But in options, you have 1.5 million strike prices against those 4,000 equities, right? So every time an equity price moves, all the options markets have changes in their strike prices. And that just creates a massive amount of message traffic. But why that's important is really to understand that the inner workings of the markets, the inner workings of the financial system have really worked really well. The resilience of the U.S. market structure and the market infrastructure has been incredibly resilient through this period of time. And I think that's something where people don't really think about it, but it is such an important part of making sure that as investors are changing their positions and as they're managing through all the news, that they can do that instantaneously in a frictionless environment. I think the entire industry has done well, and of course I think NASDAQ's done well through that as well.
The word we keep hearing is uncertainty, which is really bad for business, though not actually necessarily bad for markets. I think some folks in the administration have said that this was a bit of a clearing of the brush, maybe, that some stocks had been overvalued, that the market maybe needed to be reminded that stocks go down and up. What do you think about that?
Well, at the end of the day, what investors look for is some level of predictability. And any time you have a period of time where there's not a lot of predictability, the first instinct of an investor is to go risk off and to kind of take money off the table, sit on the sidelines, try to understand what's going to happen, and then start to redeploy their capital in a smart way into those companies or sectors where they think, okay, this is going to be resilient. This actually could be a really interesting sector to get into. This, maybe I'll stay away for a while. But that takes time. And usually, it's like this moment. It's like at the beginning of COVID, you saw a massive reduction of risk at the very beginning of COVID. And then you saw monetary action happen, and that allowed people to say, okay, wait, I think this actually could be an interesting period of time. Not every company is going to be affected the same way, so let me start to redeploy my capital into it. But it became a little bit of I would say a little bit more of a known environment when everyone realized we could actually operate really successfully remotely. We could figure out the world around us. I think right now we're in that midst of what is the world going to look like? What is this going to mean for rates? How are we going to be able to operate in this world? Where are the demands? Where's the demand? How's the demand going to change? And none of that is yet known. And so that is where we're in that kind of swirl right now, where investors are just trying to get to a point of predictability. Predictability is what really drives the economy forward. And so yes, there's moments in time when this activity level could be, beneficial to market operators. But at the end of the day, I think we all prefer a world where we have predictability.
Where are you seeing money go? I mean, utilities have had a great run, right? There's some sense that there's some defensive sectors that are starting to outperform. Are you seeing money go in interesting places, or kind of where you'd expect to see it?
I haven't seen anything unusual. I would say that also there are a few things to recognize. Technology is an unstoppable force, and I realize that they're going to be what's going to happen to the overall demand structure around the world is something we're all trying to figure out. But we also are in a mode of modernization. So every industry, every sector, every company is looking to how we can define ourselves in the future. How can we bring technology into our organizations? How can we modernize our infrastructure? That's an unstoppable kind of just trend, a long-term trend. Now, how people kind of allocate capital in the short run might change and shift. But the fact is that if we look at our own business, we have a very scaled fintech business today. We did announce in the first quarter we had 10% growth in that business. And the clients, because what we provide is mission critical infrastructure, very modern. And we'll talk about our new partnership with AWS in a minute. But it's a very modern way to manage risk, to manage their market interactions, to manage markets. That they're still, those conversations are persisting, right along track because of the fact that there's so much of a need to continue to modernize your infrastructure. U.S. is the home to those companies that are really helping the world modernize. So it's going to be interesting to see how that, kind of that underpinning of demand we see as persistent. But I think that within other sectors that it is going to be also the news of the day can kind of move a company in the short run. Over the long run, though, I'm a believer that the U.S. economy, I'm a believer that a lot of different economies in the world are going to demonstrate that we have strength, we have resilience, and we are, particularly in the United States, really driving the future of the world.
You've got a big financial crime business, preventing it, not facilitating it.
Thank you.
As geopolitical tensions rise, is that something the U.S. financial system and financial players should be worried about, that they become a soft target?
I think that the financial system and the banks, every member of the financial system absolutely recognizes that they have to have incredible defenses built into their systems. And one of the things, certainly as you've seen in terms of the world and the risk of cyber and other things, the financial system is very much on the forefront of those defenses. And I think we're extremely modern, we're extremely advanced in how we manage that. The same thing goes for financial crime. What we mean by financial crime is criminals trying to come into the system and either steal money by defrauding other consumers and certainly trying to defraud the banks, trying to defraud consumers that then use the banks to deposit or withdraw money, and then also criminal networks, terrorist networks, nation states, other groups that are really trying to make sure they might be laundering money through the system, they might be trying to defraud individuals. That is a massive problem around the world. It's a very persistent problem. It's about a $3 trillion problem in terms of how much money is laundered through the financial system around the world. And the banks have been put on the front lines to try to solve this problem. And yet they cannot solve this problem by themselves. So what we talk a lot about, particularly in an event like this one, is the need for collective action. You've got law enforcement, you've got regulators, you've got the banks, and you've got technology companies. We are a scaled provider of technology in this space, and it's one of our fastest growing business. We had 21% growth in the quarter, that's been the general growth rate of that business because it's such a huge challenge. So what we do and what we've been talking to regulators about is, number one, make sure the banks can share data, because sharing data across the banks, which is allowable here in the United States under certain laws, makes it so that we can gather up information, look at payor and payee information, look at topologies and patterns and practices of criminal behavior, and get a lot smarter in identifying those criminals, and then allowing the banks to be a lot better at trying to identify and get those criminals out of their networks, both preventatively and reactively. I think that the second thing is you've got to allow for the banks and the regulators to use AI to be very advanced in using technologies that, because all of the criminals are going to use those technologies. They're incredibly smart.
Isn't AI just going to be absolutely able to mimic the email that your aunt sends you asking? It was really targeted pitches.
Yeah, so I think that right now you've got, as you said, you've got these moments in time when disruption tends to kind of give rise to creativity, positive and negative. But what happens also with the use of technology is that the criminals are going to get better and better at trying to fool people, to fool the banks, to fool the system. And what we need to make sure as regulators, as legislators, as law enforcement, and as technology providers is that we are allowed to deploy the best technology available in the world to defend the system. And AI is obviously going to be a game changer for defense, in addition to being, unfortunately, a game changer for the criminals. So we are very advanced in the AI that we use within our Verafin platform, both in terms of identifying criminals and in terms of automating workflows, so that you can actually be much more efficient in driving the solution.
You know, a couple of years ago, sort of one of the cutting edge customer ID tools was voice recognition. You know, you could call and it would know who you were, and like, boy, did that have a shelf life of about 10 minutes, right? I mean, I think a lot of the AI generated stuff is just, it feels like it's advantage criminal at the moment. How do you think about it?
Well, I would look at it this way. It's quite insidious, like the way that they can try to gain entry to your life, try to kind of pull on your heartstrings. So, you know, the ones that are just, there's so many terribles that you see within the world of financial crime. But the ability to trick a person by using, let's say, an elderly person who's recently lost a spouse. They're lonely and they're afraid. And the obituary was in the news, right? So unfortunately, they are an incredible target for scammers. And so they then, and oftentimes they're not as technology savvy. And so they can kind of they can get targeted in a way that's really, it's just terrible to see. What's really great though is you hear great stories. I have to say, you do hear great stories from the banks where they teach their tellers, just if someone is coming and suddenly wanting to make a major withdrawal, they have been taught and taught and taught, do not allow that to happen until you ask like 100 questions. I mean, and maybe for you all, as you're going into the bank and trying to make an unusual withdrawal, you're like, gosh, why are they asking me so many questions? But they're doing it for all the right reasons. But that's the kind of thing, that training that happens on the ground. But it also has to be behind the scenes. When that wire comes in, we have to be able to stop that wire. We have to be able to make sure that at the end of the day, systematically, we're also able to block those types of bad transactions and make sure that these criminals just are not successful.
You operate markets all over the world, particularly in Europe. It's a bit of a moment for Europe. It outperformed the US and sort of in the stock market this year, seeing a lot of industrial policy and government spending and some interesting things. But a real competitiveness problem, right? This is what the Draghi report last year, and you see it, I imagine, particularly in, you look at the number of startups coming out of Europe, and even the ones, Spotify, I believe, when it decided to go public, came to New York. So when you, particularly your experience, I think, in the Nordic countries, like what you see, what European investors need to do to build the kind of capital markets that would let them kind of keep their national champions and really compete for capital? Yeah, so just to take a step back, so I mean, if you think about the European Union, it is a huge economy. There's 100 million more people that live in Europe, but then it's just a huge economy. But at the same time, it has just a slower growth profile. And the capital markets are not as deep and liquid as they are in the United States. Now, there are a couple exceptions to that, and I would say that we're very proud to be the owner and operator of the markets in the Nordics, and in particular in Sweden. Small country, very outsized weight in the world, right? It's this country of about 10 million people. But what's really interesting when you look at that country is why the markets are deep, the markets are liquid. We've had I look at things in the span of my tenure as CEO. So in the last 8 years, we've had 450 companies go public across the Nordics. And that's a great testament to the innovative spirit of the Nordic countries. But why is that? Like, why is that? I mean, it's almost as many as has happened all over the rest of Europe, right? So, and it's not because of us. I mean, it's partly because of us, we'd like to think. But let's just say it's a part of. There's a lot that underpins that. Number one, the country decided, decades and decades ago, that for them to be an outsized weight in the world, they had to be a major international exporter of their talent and of their capabilities. So they grew these really international businesses, and they're very global in the way that they've expanded their businesses, number one. Number two, they have a great university system. They invest a lot in technology, in research, and R&D. They have a great system that underpins that, but they have an innovative spirit. Then they also have been really encouraging everyday citizens to be investors in the equities markets. And in 2012, they launched a program that really changed the game there. That is it's a total exemplar for the rest of Europe. They launched a program called the ISK program, which allows investors to invest up to about $1 million into a savings account
where they only get taxed 1% of the total value of the account, no cap gains tax at all. And all their only requirement is that they invest in public equities. So the ownership of equities in the country literally just went straight line up from there. And so right now, the United States, 36% of household assets are invested in equities in the United States. Sorry, 39%. In Sweden, it's 36%. In the rest of Europe, it's less than 20%. And so it's a really interesting, I think, kind of true test case or case study in how a medium-sized economy can have a great capital market when you are very intentional about programs. And then, of course, they also operate with very advanced technology in their markets. I think that we really do focus very much on market structure that is retail-oriented. They have a great pension system, and the pensions are very good at investing in domestic equities. So that flywheel effect is really special. The Draghi report actually calls it out as being kind of how can we look within our own continent and realize that there's a way to succeed. So we've been very engaged with the regulators and legislators across Europe to talk about how do you expand that? How do you change the culture? How do you change and make sure that innovators feel like that they can innovate, they can fail, they can try, fail, try again? How do you kind of change all of that and also focus on the plumbing? And the markets they're very, very efficient when they, in general. I think that there's some inefficiencies in post-trade side. There's some inefficiencies in some of the regulatory infrastructure, but there's also a cultural change that needs to happen.
Do you think this can be a galvanizing moment? We've seen pressure, for example, for Canadian pension funds to buy Canadian. Is there an opportunity here for a bit of a, I don't know, like an anti-US kind of rally among Europe to invest in their own companies, to stop sending so much of their capital here?
Oh, at the end of the day, I think investors always will follow the returns. I mean, and they, whether you're a pension, any sort of public pension has an obligation to their pensioners to make sure they're getting returns. But the fact is that Europe is, it's an amazing economy. It's a matter of just catalyzing the economy and giving them the opportunity to find those returns within their continent. And in Sweden, the Swedish pensions are they're very domestically focused, but they also have great companies to invest in.
But is that always true, actually? I think because we've seen some investors do some non-economic things over the last couple of years, mostly for political reasons, where they've chased, ideology instead of the last nickel of returns. Is that the world we're living in now?
My father was an investor, and he was an investor his whole career. And I think that the thing that I've always learned is that that fiduciary duty is what's going to ultimately drive behavior. There can have some, it seems that he always said that companies always revert to the fundamentals over time, right? So like the valuations always revert to fundamentals over time. I think investors also ultimately they will go to where the returns are over time. And it's a matter of just making sure that the US economy delivers those returns, the European economy delivers those returns, and just driving economic growth and opportunity and expansion is the best way to make sure that people invest in your country.
Well, thank you so much for the time.
Great, thank you.
Please welcome Dr. Ariel Ekblad, founder and CEO, Ariela Institute, and Rohan Goswami, business reporter, Semaphore.
Hi, Ariel. How are you?
Good morning. Doing well. How are you?
We're going to talk about space today. And I guess I wanted to start, since we're in D.C., you guys are obviously based in Boston, but there has been a real renaissance over the last, say, 10 years in the private sector when it comes to space. Absolutely. What do you see as the government's role in driving further innovation in the private sector?
We're really lucky now in the space economy. We have a thriving commercial ecosystem, but what we need the government's help with is with ambition. So the cost to get to space in the last 15 years has dropped dramatically. It was over $50,000 a kilogram in the NASA Space Shuttle era. Now it's anticipated to be below $200 a kilogram with SpaceX Starship coming online. That's remarkable. That's like FedEx. If you can ship something around the world, you can ship it to space. But what we want to now see is how can we do large-scale infrastructure in orbit for the public good? And that scale of ambition is where public-private partnerships like COTS, which is what helped SpaceX get started. That was the International Space Station saying, and NASA saying, if SpaceX can get us cargo to orbit at this price, we'll buy it. We now want to see a public-private partnership for this kind of next-level infrastructure. So if I can, I'll give you an example. My PhD at MIT was focused on robotic self-assembly. How do you build really big-scale things in orbit, bigger than your biggest rocket? One of the best applications of this that we could imagine is if you put multiple solar panels out in orbit above the atmosphere, you can get raw, unfiltered sunlight energy, concentrate it, and beam it anywhere on Earth, even at night. So this is a flashlight from orbit. It would fundamentally solve the storage problem for solar power. But that is a scale of project that is hard even for VCs to be able to get their minds around and to be able to fund. A wonderful opportunity for the government to come in with a public-private partnership and say, hey, we will buy gigawatt-scale continuous power for New York City or for DC at this rate, or we'll make sure that our utilities can coordinate with that and then get these projects funded. That's just an example of many that we'd love to see achieved.
We've had a few conversations here about AI. I can't imagine what they would possibly want to do with more energy. It feels like when we were all growing up, space was this fantastical thing. And there were these wonderful projects being talked about, being rendered, and then there was a dark age. What do you think was the turning point that has allowed companies like SpaceX, but also smaller ones, right, to really sort of jump back into the forefront and inspire a whole new generation of folks much younger than all of us to want to go to space, to want to build in space, to create self-assembling space stations, which sounds like something out of a sci-fi novel?
I think the major change that we saw right in the 70s and 80s is we lost that focus that we had of funding for the Cold War. And that meant that the space industry had to recover from that loss of initial government investment and government focus. It took us a little while to find a sustainable set of business cases that could actually close in orbit. And now what's happening is the cost to get to space, thanks to public-private partnership, like the government helping SpaceX get started, that has brought the costs down so low that a whole new business application layer, those business cases actually close. What that's allowed us to do is have satellites make money from orbit by taking pictures of Walmart's parking lot and telling them how many cars are in their parking lots all around the world, or selling data about rising tides to insurance companies. There's all of this opportunity now to use space in an economic way that is providing a more stable economy, and then allows folks like us at MIT to say, okay, what's the next step? Can we build the platforms, the space habitats, not just for tourism, but for really scaling up science and what we can achieve in orbit? And that's what we're getting to now that we have this, I would say, a healthier ecosystem of not just Cold War funding, but a mix of government investment, public-private partnership, and now a really thriving, self-sustaining space economy.
On the government front, we still haven't confirmed Jared Isaacman as NASA administrator. First of all, maybe you know this space so well. What do you think of Jared? What do you think he'll bring to NASA? Right, there's been some reporting that the government is looking at slashing at least part of NASA's funding pretty dramatically. What is your thought on all of this?
Right. So I think Jared is actually a really inspired pick. He is a self-made man, really well-established business person. I think he will bring a certain level of focus and agile business management to NASA, which is important. It really is important for NASA to be run well. But what I love about Jared is that he was spending his personal wealth to do a private spacewalk with SpaceX. He's deeply passionate about space. He's courageous. He put himself out there. And so I think he brings that passion for space and the next era of research to the agency. And what I'm hoping he will do is fight for that science budget. Now, I know it's easy as a scientist. Of course, I don't want my thing to be cut. We're all facing this in DC right now. Nobody wants their thing to be cut. But it's just an important reminder that when we cut science funding at this scale, there are really massive impacts to aviation, to basic human factors saving. It affects FAA. An example of something that's on the cutting block right now is heliophysics. You might ask yourself, in the face of so many pressing challenges here on Earth, why are we funding heliophysics? Well, wouldn't you like to know when the solar flare is coming that's going to essentially decimate our existing on-Earth electromagnetic spectrum, all of the ways that we communicate now? We need this kind of fundamental science knowledge, and I'm optimistic that Jared is going to be able to find a way to negotiate within the constraints that he's going to be put under and be able to find a way to protect some of that funding.
But in addition to being a scientist, you're also an investor, right? You launched a VC last year. In the short term, maybe the next 5 to 10 years, what do you see as sort of the immediate applicable investable technologies in space?
We invest in 4 core areas, and I'd love to go deep with you in one, in the biotech area. The first is satellites. It's where most of the money is to be had in the space industry right now. So that's telecom, satellite constellations like Starlink, new ways of doing GPS. Really important to think about the national security and how that interplays with space investing. Right now we have GPS satellites that are massive targets for hacking, Russian and Chinese hacking. Can we use a Starlink-like approach to GPS? Have a distributed low Earth orbit constellation of satellites that are offering not only better performance because they're closer to Earth, so you'd actually get sub-meter scale resolution on your phone, but you have a resilient network, much harder to take out a GPS network if it's distributed with multiple small assets in low Earth orbit, for example. So that's one big chunk. We do satellites, whether it's data products or hardware of the satellite constellations themselves. We do what I would say is energy security. So we look at investing in things like space-based solar power. We look at technologies that would transfer well from orbit to Earth for the benefit of life on Earth. Great example is minimum viable product for a space habitat has to be really energy efficient air conditioning, really good air filtration, and direct air carbon capture. These are three technologies, a trifecta of which we desperately need in Earth-based markets. You know, we're building new homes now that for the first time in human history with wildfires need to be airtight. Can we use some of this technology from space and improve life on Earth? And then the third category I want to mention is biotech. This is new, but a really, really special example of what can we only do in the space environment that we could bring back to Earth. So in microgravity, when you're in free fall around a planet, you have this sensation of floating. And we know that certain key biological samples behave differently in that floating environment than they do on Earth. So two great examples, one of which we've already invested in. You can manufacture artificial retinas that would cure macular degeneration, cure blindness as we age. You can manufacture those in space in a way that you can't make them here on Earth. Here we have sedimentation, we have gravity, those little delicate tissue samples are going to sag, but we can manufacture them in orbit, stabilize them, and bring them back down to Earth. And one of the other most captivating examples that we now know of, thanks to NASA research and NASA science funding that produced this research, is organoids, these tissue models that we use to test cancer drugs and Alzheimer's drugs. We have found that, not me, my personal lab, but NASA as a whole with the ISS National Lab, have found that certain organoid tissue samples grow faster in zero-G. They mature more rapidly. So that's an opportunity to produce a higher throughput volume of these really critical tissue samples for cancer testing. So huge opportunity, I think, in biotech. And from an investor standpoint, we think biotech is probably going to be the anchor of the next wave of the space economy.
A whole set of labs up in space. Well, Ariel, we're out of time. It was a huge pleasure. We could talk about this for hours, probably.
Thank you so
Thanks
much
for coming to join us.
Thank you.
Please welcome Ali Osman, Chief Investment Officer for Artificial Intelligence at MGX, and Mohammed Serge, Gulf Editor at Semaphore.
Thank you, Ali, for being here, and welcome to the last day of World Economic Summit. So I wanted to start from the beginning and kind of get a quick introduction from you. We have a lot of sovereign wealth funds in the UAE specifically, and it's kind of an alphabet soup at this point. So what is MGX, and why do we need a new one?
Well, Mohammed, thank you very much for having us, and thank you to Semaphore, who've been hosting an amazing event in Washington this week. So what is MGX? I'll take you back to when we started thinking about putting this thing together. About a year and a half ago, we came to the conclusion as a broader ecosystem that investing in artificial intelligence required a new approach. We couldn't invest by risk class or by asset class or by geography. We really needed to have the ability to invest across the broader thematic, the broader ecosystem. And so we put together ultimately the first AI native, AI thematic investment vehicle and an investment fund. It's organized as a GP that allows us to be a lot more agile in the market, to be a lot more competitive in a very competitive AI investment and tech investment environment. And because we have the ability to invest across the ecosystem, we're really focused on investing in semiconductors, AI infrastructure, such as data centers, and AI technology and advanced technologies. And because we're able to invest, again, across the ecosystem, we can bring the ecosystem to bear in order to create value. That's really at the core of what MGX is able to do today.
And what would the size of the, what is it today, and where do you expect it to be?
So listen, I think you need to invest at scale in the space. If you look at any of the different pillars that I've just described, it requires a critical mass of capital. Semiconductors requires billions of dollars of capital from an investment standpoint. AI infrastructure and data centers requires tens of billions of dollars, if not trillions of dollars, to really put the amount of compute required to be ultimately built out. Same applies to AI technology and advanced technologies. And so we're looking at acting at scale, making concentrated, high conviction investments across the ecosystem, across these pillars.
Yeah, so it's like is that $100 billion? Is that the kind of the target to deploy?
So we haven't disclosed the fund size and the fund number. The easiest way to think about it is that we're investing equity checks between $1 to $2 billion per transaction, and have the ability to invest, call it between $8 to $10 billion a year, is the way we're thinking about it.
Yeah, so over a decade, that's kind of where you'd get the opportunity where you're going to go into. Like, if you can break it down a bit in terms of the allocations, right? So what goes into infrastructure, what goes into applications, so on.
Yeah, absolutely. So our view is that let's start in the infrastructure, because that's really where the vast majority of the capital in the short term is required. So if you really map it out, we're thinking about what the compute build-out requirements are from a capital spend perspective. And one of the biggest challenges in data center build-out today is really forming the right scale of capital and forming the right longevity and duration. The current vehicles that are investing in data centers today don't provide the right longevity, right? They're closed-ended funds, they're mismatched in terms of time horizon, they can't form capital at the scale that's ultimately required. And so for that reason, we've put together, alongside BlackRock, GIP, Microsoft, and recently NVIDIA and XAI, the AI Infrastructure Partnership, which is a $30 billion vehicle, open-ended, meant to really form capital at scale, leveraging that longevity to really support large-scale platform developments in data center. That's going to be a majority or a very significant proportion of what MGX does from a capital deployment perspective. Same applies to semiconductors. If you think about the bottleneck in leading-edge manufacturing, that requires tens of billions of dollars from a capital formation standpoint. Our view on AI technology and advanced technology is that we're currently at a crossroads around what the future of investing in technology looks like. A lot of software investors and technology investors today are really thinking what that model looks like in an AI native environment. I'd say the next 12 to 24 months will be very telling for that space. And so I'd say we're looking at businesses that are AI native, that have been born in this environment. They generally reach profitability a lot quicker. Their capital needs look different, but they're ones that really transform the value proposition for their end customer. There are also businesses that can be transformed leveraging AI. These are not native businesses, but businesses that today may be considered as a legacy platform, but can really transform their ability to deliver against the customer value proposition leveraging the technology.
So is it like 60, 20, 20 kind of thing, or something like that?
I think it's hard to kind of call it out. I'd say about half the fund is really focused on investing in infrastructure with a split across.
And the infrastructure one is where the projections are, I guess, the most extreme in terms of what is going to be required in terms of power of data center capacity, and then how much it's going to cost, right? Because costs do come down. It's still about $10 million per megawatt, but it seems that we might not need all of the 300 megawatts that are coming. So do you have any changes in kind of your forecast? So what's the minimum that is required?
So our view is that whether you're a bear or a bull, and I've said this when I spoke to some of your colleagues in Davos earlier in the year, whether you're bullish or bearish in the space, you're still looking at capital formation to the tune of trillions of dollars, right? And so yes, on an absolute basis, something like the AI Infrastructure Partnership that we've put together has a large capital formation capacity, but on a relative basis compared to the need, it's still a drop in the water. Even with some of the news that we're hearing about pullback from a capacity build-out perspective from some of the large hyperscalers, that is still quite small compared to what our view long-term are the compute needs and the capital requirements in order to really enable the adoption of the technology on a broad basis.
Do you have any visibility on the compute that's being used at this point? Is everything kind of maxed out and it's just
Listen, the demand is still very high. You're still looking at global install of around 60 gigawatts. Our view is in the next 5 to 6 years that still needs to get to 200 to 300 gigawatts. That hasn't changed. And we are deploying capital in order to support that build-out growth. We think that capital really needs to be formed, number one. Number two, the needs to deploy it here in North America and specifically the United States is extremely important. And that's really where we see the technology going even here.
Yeah. So, one of the consensus that's coming out of this week here with the IMF meetings and in our meetings, there's a sour mood in the U.S. right at this point in terms of the economy and where it's going to go and trade and all that stuff. it seems that you have kind of an opposite message. You're looking to deploy capital here.
Yeah, I think, listen, we're very much still risk on and in market. And we remain optimistic. The technology will revolutionize the way we create value in the economy. And the United States continues to be at the bleeding edge of this technology. So I'd say I'm maybe a little bit more, maybe a contrarian, but a little bit more optimistic than the broader, the broader environment. Probably the additional point I'd make here is that we're taking a long-term view in terms of the evolution of this technology. So you can't, the current environment is the current environment today, but we know what the need is if you take the 5 to 10 year view, and we need to make sure we're building to continue driving the United States that edge, that bleeding edge.
What does, MGX, you go out and you invest money, you get a return, that's a great portion of it, but is there something else that's going to be, a benefit to Abu Dhabi and to kind of bringing talent and technology and tech there? Is that a portion of your mandate?
I think it's a piece of the mandate, absolutely. We're looking at advancing Abu Dhabi's role in artificial intelligence more broadly, whether it's from a tech development perspective, also ensuring that there are platform leaders that we can support, targeting geographies that don't have current capabilities today. I'm thinking about, for instance, our data center platform, Khazna, which is a great candidate that can really target data center compute build out in the global south. So it is important. That is an important part of our mandate. But ultimately, we are an investor. We are driven by generating financial returns, and we're assessed as such.
Okay. And then the last portion that we didn't talk about is blockchain and I guess to some extent crypto. MGX invested. I don't know about the exact structure because it's crypto, but $2 billion into Binance in one way or another through tokens and so on. I know you weren't responsible for that deal, but if you can speak a bit more about where is that intersection of data center, AI, and blockchain?
Yeah. So blockchain is part of our broader advanced technology strategy. And our view is that you can't really detach advanced technology from artificial intelligence. It is very much part of the broader effort. We think that blockchain unlocks a tremendous amount of value in AI native applications. And that's one of the reasons why we looked at the Binance situation as one that we thought was particularly attractive for MGX to be a participant in.
Okay, got it. Okay. Well, thank you so much, Ali. And this was a very interesting conversation. So
thanks for having me. Thank you.
Please welcome Salil Parekh, CEO of Infosys, and Justin B. Smith, co-founder and CEO of Semaphore.
So, we joked the other day that if it weren't for tariffs, we'd be talking about AI all 3 days. So we can actually now pause on tariffs for a little bit and actually have another deeper AI conversation. So there's this incredible gap between AI ambition, AI enthusiasm, AI dreams, and then AI execution and AI scaling. And there's very few people in the world that are probably more knowledgeable than Salil Parekh at this exact question of actually taking the dreams of AI and scaling them, implementing them at the enterprise level. So welcome, Salil. He's the CEO of Infosys, one of the leading digital services companies in the world, one of India's great companies, great multinationals. So Salil, welcome. Please give us your thoughts on on why companies struggle to move past AI pilots to AI at scale, and what are they doing wrong? What do they need to do? What's the magic here?
So first, thanks, Justin. It is great to be here in this session, and great to not talk about tariffs. On AI, first, the promise of AI is incredible. I think there's a distinction between consumer AI, which all of us experience every day with everything that's going on, and enterprise AI. Now, there's enormous potential in what large enterprises can do with AI. Some of the constraints, one, there needs to be a clear way to demonstrate benefit at scale across the company. Most of these companies are built from acquisitions, and so
there are various components to these companies, not a uniform set of structures that allow AI to be deployed. Many things that we do with AI in companies need a strong data infrastructure, and most companies don't have that. They have good data infrastructure for data that's within the company, but a lot of the unstructured data, consumer sentiment, it's not easily captured by these companies. What really needs to happen for scale to come into play is make sure that the AI capabilities that companies are driving, let's say for example in customer service, are capabilities that can be applied in each area of that company and not just in one part of it. The promise that has been made by many external providers, many technology companies for AI sometimes is not reflected, because many of the implementation blocks, many of the implementation impediments come into play with different divisions, different compartments of a company, and not allowing the scaling to happen that effectively. So those are some of the constraints that we are seeing. One of the ways that we want to make sure...
Are you already seeing large companies beginning to win and beat their competitors because they're scaling AI better?
So the ones that are working really well are the ones that are almost native, that have started with AI being part of everything that have been growing up. And those are typically startups that have grown up very well.
Any examples of legacy companies that have been able to do it that, or to sort of inject it or deeply and natively?
So there are some examples. We are working with 400 different clients on AI. There's a telco here in the US which have basically put an AI infrastructure across their whole company, not just in one part of it, which is working very well. There's a large accounting firm where they basically use agents. Agents are things within AI that are starting to work extremely well. Agents across their audit process.
And is the ROI close to immediate?
It's substantial, but there is a time lag to it. So maybe within about 9 months or so, the benefits for this specific example came through. But the benefits are substantial because a lot of the work that they were driving through with their junior staff is now being driven through these agents.
And so why are some companies going all in so quickly, and if it's such a quick, rapid, positive return? Why isn't every capable CEO doing this?
So almost everyone is now jumping in to do something with it. So there's no discussion that we have with any client that does not involve AI. The constraint really is more on what the expectation is. So you take the area of customer service. There we see clients getting benefits of 30, 40% in terms of productivity, but they also get increased capability in service because there are problems that they can address which were not previously being addressed because of the ability to intelligently mine all of that data. You look at things like credit risk assessment, and we have clients which are doing that, much better ability to drive credit risk assessment. We're working with clients on drug discovery. Again, they're much faster return in terms of the time spent on clinical trials. So there are examples which are specific to different industries.
But is this sort of the depth and the intensity of the transformation using AI a leadership choice, a board choice, or is it an industry choice? Where is the choice being made, or where's the lever?
So there, the way we've seen success come through is where the leadership is fully committed. For example, working with a client in a bank, we have the bank CEO on a monthly basis working with our teams, reviewing what the progress is, and you can see the change coming through with that bank in terms of AI. The real driver is someone who believes that this can help them and show tangible results through their company. What we see with boards is quite different. I think boards typically we found are quite impatient with getting the change going, but sometimes not fully aware of what needs to be done. And in that rush, some of the early examples of the projects being done may not result in a benefit, and so some frustration being built up. But where we see real benefit is where the business side and the technology side in a company, driven by the leadership, are working to make these changes.
And what are the questions that a CEO needs to be directing to his CTO? What's the most important urgent question?
So the most critical question really is, from my perspective, is there a benefit that the business see and that the technology can support, and not just being driven for the sake of technology? There are examples or use cases where the technology is incredible, but there's no real business support for driving that through. And the second is the company or the organization ready for the change that's going to come about? And it's typical of these large technology projects that if those two are not addressed well enough, we are more likely to see failures on those projects.
Are there examples of companies that are over-embracing AI too quickly, and perhaps that you think that it's reckless?
So today, almost everyone that large enterprise world has gone exceedingly fast in the first phase. And what we are now seeing are people sort of stepping back and saying, let's look at what is sustainable in terms of driving a benefit through this. And so that's, and part of it is not that the large enterprises were doing it in a wrong way. There was tremendous pressure because of consumer AI making so much change that you go home and the way consumer AI is being used, you almost compelled to drive something within the company.
So it's often said that one of the biggest obstacles to scaling AI in large enterprises is actually not the AI itself, but rather the people. What are your thoughts on that? And how can that be overcome as an obstacle?
So on the people, you're absolutely right. I think the constraint that we see there is people being open-minded in organizations, because this is a huge change for the day-to-day work of large numbers of people. Let's say the credit risk example, or let's say the drug discovery example. And so that openness to change needs to be very much part of it. And the support, because there are likely to be many failures on AI projects. So the support from an organization that when those things go well, you're supported, but when they don't go well, you're not thrown out because that's something that's gone wrong.
So we have 15 seconds left. What's your lightning round answer to best advice you've ever given a CEO about their AI strategy?
The best advice we've given, or certainly I've given, is be sort of long-term in thinking, but not too impatient in the short term.
Okay. Well, thank you so much. So it's wonderful to have you here.
Thank you very much.
Please join me in thanking Salil. Very good.
Please welcome Sridhar Ramaswamy, CEO of Snowflake, and Reed Abergati, Technology Editor at Semaphore.
Hello.
Hello.
Thank you for being here.
Excited.
So Snowflake is at this interesting place in the AI explosion, right, where the data meets, actually running these models. Yeah. You can see this from this bird's eye view. So what are companies actually doing right now with these models, and where is it headed? Where do you see this headed?
Yeah, Snowflake has been around for now close to a decade, and it's typically been used for what we call analytical processing. Everything from people closing books to getting insight about how's their supply chain doing, or for me, for example, how is sales doing, and so on. And what AI has done is it's broken down barriers to how quickly people can get at this data. It used to be that if data is sitting in a platform like Snowflake, you need the priest class, you need analysts who can write these magical things called SQL queries and create dashboards, and that's when it shows up for a business user. Now we have systems that can take questions in natural language and be able to reliably answer them. Similarly, as anyone here that's tried to repair their washing machine knows, looking through a PDF that you search on the internet and finding page 46 to see what that error code means, not fun. But people do this at work all the time, where they have to sift through mountains of information. People are creating a lot of interactive chatbots for just this kind of what we call unstructured information. Siemens, which makes 150,000 different kinds of devices, created a chatbot for their field workers to be able to ask questions of, I'm seeing this error code on this kind of a machine, what does it mean? It's just simple things like that. Those are the ones that are getting deployed at scale.
Okay. So you led advertising at Google, and then you started this search engine, Nevo, which was actually really good. It was this privacy-focused search engine. A little bit ahead of your time, because now you see this explosion in AI search. There's Perplexity. There's people are using OpenAI, Gemini. What do you think of AI search, and what is the future of search?
Yeah. I led the ads and commerce teams at Google for over 5 years, and intimately familiar with search advertising, ran the travel and shopping teams, and so on. And it's fascinating to see how rapidly it's evolving. One of the worst kept secrets on the internet is that OpenAI, ChatGPT, has, I think, 800 million something users, and growing at multiple percentage points every week, which is wild. I think it'll be one of the fastest billion user products in the world ever. I think it just reflects the fact that none of us likes wading through a series of links or clicking around to get an answer. And ChatGPT's model, especially when it's backed with search, so you don't have to worry about things like hallucinations, of giving you an answer. Anytime I want to look up information about a company, Salil was here just now, if I want to know a quick summary about Infosys, the stock and the company, I just ask that in ChatGPT, and 3 seconds later, I have that quick summary. I think more and more of these kinds of simple questions are going to be answered by the likes of ChatGPT. I think there's something interesting happening on the other side as well, and I've spoken about it. I'm sure all of you don't particularly like shopping on the internet. It's just really hard. Something as simple as buying airline tickets, you have to go to multiple sites, figure out, compare, and buying other things like shoes and so on. It's a true pain. But I don't think we're that far away from a moment in which you can roughly describe what it is you're looking for, and you can have agents that can do a pretty good job of running searches on your behalf, assembling reports. It's early for this kind of stuff, but you can already see the genius behind things like deep research, which I use a lot, for doing in-depth research with stuff. And so I think search is under attack, both on the simple questions that people prefer answers for, and the complex stuff where you and I have to wade through lots and lots of information that we have no interest in doing, and how do you make that kind of an experience better? So I think there's a lot of change coming, and obviously it's interesting. It'll be interesting to see how much Google is able to adapt to these kinds of changes.
So Google is obviously a leader in AI, and their AI search is pretty good. But what's the role of advertising in that kind of a search, do you think? Can you still sell ads against a deep research that you described?
I mean, I think this is one of those situations in which you need to embrace and win and not worry about business model. This is the reason why established companies struggle to innovate, because they try to answer questions like that out of the gate. At this point, it is existential for Google to be relevant in the world of search. The money will come. People will figure stuff out. I can go back to my own history at Google when, first of all, desktop search had flattened out. PC sales, well, flat as a pancake, 2008, 9, it just stopped. And so our query growth, none. And mobile was just then coming along, and it made 1/10 the money that desktop search did, and yet it was the only place that had any amount of query growth. But Google's genius then was that they created Android. We cut the deal with Apple to power search and search advertising. We captured the market, and then my team went through a 5-year grind of increasing RPMs, the money that we make on mobile queries, from the 10% much closer to the 100%. And so I think like it is really important to internalize that. My funny way of saying this to my team at Google would be, you know, it is way better to have a very large business with bad margins than to have a very small business with amazing margins. I think that's what's going to happen with AI as well. These lessons keep coming back again and again.
That is really interesting. You know, I've been out here a couple days in DC talking to a lot of business leaders, and there's a ton of uncertainty right now in the market, and I hear this a lot, that, you know, we're just going to hold off on investment right now. We're going to slow things down. We don't know what the future holds. Is that the attitude in Silicon Valley, and what happens if those companies do decide to pause?
I mean, obviously, this is going to differ by company, but when it comes to tech spending, when it comes to things like Snowflake software itself, people are not going to react all that quickly to it. As I was saying earlier, people use us for things like supply chain optimization, advertising optimization, closing the books. These are not things that you can one fine day say, like, I want to do a little bit less of. It becomes, you know, that's not quite how things work.
Yeah.
And if anything, results from companies like ServiceNow reinforce the fact that there are not yet technology headwinds, and in fact, things are fine, and things like AI are an accelerant. That is generally what we see. But you know, you're right. We have customers that sometimes make commitments of $100, $200 million for spending with Snowflake over the next, you know, 4, 5 years. Will there be worries about getting into those kinds of agreements? If the current situation persists, like that's a natural consequence. So I think this will play itself out quickly. But when it comes to AI companies, when it comes to Snowflake, certainly, we are lean forward with respect to how much we think our technology can help our customers achieve.
Yeah, so you're not slowing down.
It doesn't make sense to slow down.
Right. So you testified in the Google search trial. So I'm just curious, just broadly speaking, there's a lot of antitrust happening right now around the world. Do you think these companies really need to be reined in? And do you think it's a good idea when, you know, they are sort of leading the charge in the development of AI, which is in the national interest?
Look, these are big, complicated topics. And I'm a big fan of history when it comes to these kinds of areas. We go through cycles. And I think we went through a cycle of thinking that antitrust is completely useless and it should have no purpose whatsoever, to saying perhaps, you know, there is such a thing as too big. My very high level take is that companies should not approach the size of countries. Why? Because they are unitary in nature. They are profit maximizing. They're not for any kind of social good. I'm not saying anything dramatic here. That's the construct of a company. And so that's the bar that we should have when we think about what does antitrust mean for us as a nation. There's a bunch of stuff. There's way smarter people than I am that are going to think through these topics.
That's interesting. So I looked at the stock price of Snowflake. I know that the ChatGPT moment was before you took the helm, but obviously there's going to be an increase in demand when all of a sudden this, as you said earlier, this unstructured data becomes valuable, but the stock price didn't move at all. And I just wonder, like, do you think that the markets kind of really understand what's happening right now, or do you think there's like going to be a lag time before people, you know, grasp?
That's a good question. I think last year was interesting for Snowflake. We obviously went through a management transition. I took over from the legend that Frank Slootman is. There were also questions about how nimble and quick we would be with fast-changing things like AI. And over the past year, what we have shown very decisively in the market is that we have an amazing ability to create great new products, to deal with unstructured data, for example. Our search index is, bar none, is the best in the world when it comes to how can you create chatbots quickly and efficiently. We have gone through a process of demonstrating to our customers that AI can be easy to implement. I tell people you can build a chatbot on Snowflake in less than a couple of hours on a custom data set. It can also be efficient. We don't ask for big commitments from our customers. And we emphasize things like trustworthiness a lot. In business, you need to be able to believe your answers. My way of telling that to my AI team is when Scarpelli, my CFO, asks how much revenue did Snowflake make yesterday. That's not a probabilistic answer. That's not a matter of debate. He needs exactly one answer and better be the right one. So I think we have shown an ability to move quickly and get things done. Obviously, we are going through, let's call it turbulence in the stock market right now. But I feel very optimistic about where Snowflake is as a company and the general trajectory of where we are headed, both with data being more and more critical, but AI being a massive accelerant to how you can get value from that data.
Well, you mentioned trust, and I know hallucinations are a big problem where these models are confidently wrong. How are you dealing with that? Are there any new techniques that people are using? And I'd love to hear about it.
Yeah, first of all, we need to think about AI programs the same way we think about software engineering. When any of you, even if you know nothing about software engineering, download an app on your phone, you actually have an implicit understanding of what that thing is supposed to do, and you expect it to do it. It's the same as when you get, when you pay for something with your credit card, it's like you have a notion of right and wrong, and we all get super annoyed when sneaky tips get into how we pay our bills. And so I think we need to think about AI the same way. It needs to be a software engineering discipline. So we work on things like how do we help our customers measure what we call the precision. How often is an AI app correct when it gives you an answer? And then things like what fraction of questions that it should answer is it actually able to answer? It's a metric called recall. But again, this is not rocket science. People have been doing this for decades now. And we have frameworks so that when there is a new model, for example, your chatbot doesn't go crazy because the new model happens to behave differently. So it's a lot of demystification. We acquired a company called Truera to help us in this space, essentially of putting together these software engineering frameworks that says before you release a chatbot, this is the process that you have to go through. This is what right is, this is what wrong is, and this is how you iterate and make process. That's how we build these buildings. But again, every person that creates a new technology thinks they are so unique that regular things like software engineering and discipline don't apply to them. AI is going through that youthful phase. It'll mature.
I think in the last seconds that we have, I'd love to know kind of what your vision of the future is, right? Because you talked about some of the use cases now, but with all of this data at your fingertips and these powerful models, where are we headed? Can these things essentially run businesses one day? Where do you see it going?
I mean, I see them go up the chain of abstraction. What I mean by that is talking to a chatbot and getting a compact answer for something that is also correct is way better than having to click through a bunch of links. Similarly, asking a question and getting a quantitative answer. How much revenue did so-and-so company make yesterday? Is it going up? Is it going down? What's the trend? To me, is a step forward from having to wade through a bunch of search results or go to a dashboard to get at the same thing. But we do compound things all the time, meaning we are going to read some piece of news. We are going to look at how did a stock perform or how did this particular customer do as we get ready for a conversation. We are now creating systems at Snowflake that can begin to address some of these. Hey, look at 3 or 4 different data sources, assemble answers for me that will get me ready to be able to do something. The next logical step is if something is wrong or something is going exceptionally well, what are the reasons for that happening? If your revenue went up, is it in a particular region? Did it go down because it was Easter in Europe last week? It's those next steps. So to me, progress is going to get made in terms of what are more and more complicated things. We have customers, we have insurance customers that routinely do underwrite things like these buildings, and it's a multi-week project for them to look through the hundreds of PDF documents that they will get about every aspect of this building before they can decide whether they should underwrite something or not. I think that can get accelerated to a matter of hours, where a lot of the drudge work is automated. It'll be human guided. It's not the case that all of a sudden, a system can run a business. But as we walk up this chain of abstraction, you get more and more value along the way.
Well, I'm looking forward to that when that day comes. Great to talk with you. Thank you so much.
Thank you so much.
Please welcome Andres Glusky, CEO of AES, Daniel Marks, CEO of Edinor, and Tim McDonald, Climate and Energy Editor at Semaphore.
Great. Thank you both so much for joining us and continuing the conversation on the energy side of the AI challenge. And I'm very interested to hear two global perspectives on kind of scaling up the grid and what we need to do. Andres, I wanted to ask you one thing, sort of following up on what Secretary Burgum was just here talking about on stage. He was making an observation that from his point of view, what he said was there's no magical solution that has appeared yet where we have load shifting using batteries in conjunction with intermittent energy that's affordable and cost effective. Is that true from your point of view? I mean, is renewables plus storage a cost effective energy solution at this point?
Okay. Well, first, I agree with the Secretary. There are no magical solutions. All right. What I'd say, we're the biggest supplier of clean energy to corporations in the world. So we're the biggest supplier to data centers as well. And about 60% of our business is in the US. So I think there's too much talk about, in my opinion, about a specific technology and rather the results that you want. So really, we're customer driven. So the customer tells us, I want affordable power. I want it, say, round the clock. I want it low carbon. And then we'll put together technologies that satisfy that need. So we actually invented lithium-ion batteries about 15 years ago. And it's been very exciting to see how the cost curve of that has come down. So I think that, look, it depends on the resources you have. You know, one thing is Death Valley in California or Arizona for solar power versus Maine. You know, so what I do think is that, you know, we do have cases where using batteries, solar, wind, and some hydro, you know, we've been able to put hourly matched low carbon energy for some of the data centers for 20-year contracts.
So renewables plus storage still seems like an effective solution for data centers and solving that part of it.
Yes, I mean, honestly, it's interesting. Before, I always argued that, look, you need some gas in the mix to make it cheaper. And now I would argue that you need renewables in the mix to make it cheaper. Now, there is a bifurcation. You know, outside of the US, the cost of solar panels is very cheap, you know, with the oversupply that there is in China. And the same thing with batteries. So outside the States, quite frankly, it's very hard to you know, in most locations, to compete with renewables.
Yeah.
You know, like a new gas facility versus renewables.
Right.
Is quite difficult.
The renewables will be very competitive.
Very competitive.
Yeah. Daniel, can you give us your point of view from Argentina? Tell us a little bit about how your grid is changing there and some of the evolution that you've seen. And I know Argentina also has, of course, dealt with some high inflation in the past. And how does that affect your experience of the energy transition?
Yeah, I would mention perhaps several aspects to it. One of them is the government made a high priority in balancing their books, the budget. And a big component of their expenditures were subsidies to the energy sector, particularly the consumer. And the price level that was derived from that was also perhaps not taking care of the needed investments that ought to be made. So the first step they took in that respect was increasing tariffs significantly. So the number is more than 330% in nominal terms, although we had very high inflation as well. Wow. So that would perhaps erode a bit the real value of that. But nevertheless, now they are moving towards a more market-oriented economy. The energy sector as such was, and still is, very heavily regulated with very heavy government intervention in purchasing all of the generation that occurs, almost all of it, and reselling it into distribution companies. That's changing as we speak. In the next few weeks, we expect a new framework that would somehow be effective for the next 5 years, in which they would also optimize the marketplace, create the marketplace to begin with and optimize it.
So is that kind of market liberal? Like, I'm wondering what the lessons are for other Latin American countries from your experience here. Is market liberalization maybe one of them, or if we're thinking about decarbonizing and expanding access to energy for data centers and other new uses? I mean, what can we take away from what can other?
I think the first thing, if you want an example of things that really fail, go and visit Argentina, see where we are.
See what not to do. Yeah,
exactly.
Okay. Yeah.
And then I think Argentina is very rich in terms of resources, particularly natural gas and oil. And if we resolve and get rid of several of the bottlenecks, it could be, and it's beginning to be, a significant net exporter of energy. And complementing that with the neighboring countries, we create a grid that would really optimize the whole system over time.
Andres, what is your experience of the tariffs that are coming up now? Does that make it more expensive for you to pursue some of these projects? And is there something more that we could be doing to onshore more of the clean energy supply chain?
That's a great question. Look, we've been trying to onshore for many years. And I think we're starting to be successful at it. So first was our experience in 2020 with COVID. We were the only large developer that didn't postpone or actually abandon any projects in the US. Because as soon as COVID hit, we imported those things that we needed. And it's costly, but think of it as an insurance policy. So now we thought that regardless of the outcome of the elections, one of the things was certain was more tariffs on goods produced in Asia. So, for example, right now we have all the equipment we need for 25 already in the US that has a foreign component. Most of what we need for 26 and what we need remainder for 26 and 27 will be produced in the US. Now it takes time to move a supply chain. You can't do this overnight. So we've been working on this for years and really being sort of an anchor customer for people willing to set up plants. But what I would say is that, look, these things take time. And when you move a supply chain, you got to move it by pieces. So it is a factor. So as I was saying, there is a bifurcation in the world in terms of the cost of, say, solar panels and batteries between the U.S. and the rest of the world.
Right. So in the near term, these tariffs will raise costs for you, it sounds like, but you've been able to get ahead of that.
Again, in our case, we got ahead of it.
Yeah.
So we offlay all risk. So we signed contracts. We bought the equipment. We have the EPC lined up. So no, this will not affect us.
But it's about being sort of strategic moving forward about how to onshore more of that.
That's right.
Yeah.
And future contracts. And look, there are components and there are input costs. Right. So one has to be conscious of that with one's clients. Yeah. What are they going to need, and what things could affect their costs going forward.
I mean, could you say just a little bit about what you've learned from your experience with the tech companies and sort of planning for what they're going to need and for data centers and how you kind of work with them?
Look, we're their leading provider because we work very well with them. And I think the key is to listen to them. What do they want? Many of the things that we've done, we've co-developed. So, for example, energy with a certain carbon footprint, hourly matched for 20 years. How do you achieve that? Because, obviously, conditions will vary. So we were able to do that working together. We've also worked, for example, with Google in terms of coming up with a simulation of a grid to see which is the best way to operate it, which is the best way to run it. And now it's commercially available for other people. Yeah. So that's a little bit our strategies. We co-develop things with people, but then we make it available to the market.
Daniel, Andres spoke a little bit about the sort of bifurcation of the market here because of these tariffs. I mean, when you look at the big picture of trade now, do you see that as an impediment to decarbonizing the energy system? I mean, how does it kind of become more complicated to solve some of these problems when we have trade barriers going up in different places?
No, in fact, I think in the short and medium term, we can take advantage in the sector of that, because we've seen a significant drop in prices that we can access both for solar generation and storage. We're working very hard with in moving ahead storage problems, resolving storage problems, utilizing that to overcome some of the bottlenecks that we have in the transportation system particularly. And we've seen those prices coming down significantly, and the technology developing at the same time, and that made available to Argentina. We expect this, the projects I was referring to, just to get started in the next 2-3 months.
Wow, really? So you've seen prices for those coming down just very recently because of the U.S. tariffs, or for other reasons?
I would say it's a combination.
Yeah.
We have oversupply as well.
Right. Yeah, that's so interesting. The other thing I was going to ask you about, Andres, from Secretary Burgum's comments, he was speaking a little bit about this resurgence of coal. Can you say a little bit about your coal assets? Do you see a big resurgence of coal coming for the U.S. anytime soon?
Look, I think, again, the way we focus on things is, again, what's the end result? You know, people don't consume kilowatt hours. They consume cheap, reliable, right, and as low carbon footprint as possible energy. So definitely in the States, what you've had the retirement of a lot of coal. So in some cases, you can combine the fossil fuels with the renewables and get an optimal result. So obviously, there's a time component here which is totally missing from the discussion. What can you do? There's a role for, obviously, fossil fuels. There is a role for, let's say, not decommissioning existing fossil plants, because that's immediate, right? There is a role, but then if you want to talk about, say, a new gas plant, that's going to take you 5 years to build, to get the turbines and build it. And if you talk about a new technology like SMRs, which we don't know the price, we don't know the permitting, that's a decade away. So I think this, honestly, in the media, to be honest, these things get confused. It's like nuclear or renewables, gas or renewables. No, it's like, what do you want as the output? How can you optimize it using the new technologies?
Right, and thinking about your existing asset base and what you can do with the thing. I mean, did you have plans previously to phase out some coal plants, and is that being extended? Or their lives are being extended?
There are some cases where we will not decommission a coal plant because it's needed, or because we are not getting the regulatory approval. So it is true that the surge in demand, you do need different sources of power. So like the Secretary was saying, I don't think there's a single technology which solves all. And it's the combination of these and applying them with the new technology.
But you're having to reconsider some of those timelines now, or?
We have reconsidered a few of the timelines. This is true, because it's just what is available now to meet our customers' demand.
Yeah. That's great. Well, Daniel and Andres, thank you so much for this. It's really interesting, and you're both dealing with this challenge in different ways. So really appreciate your time here, and thank you very much.
Thank you.
Great. Okay, thanks.
Thanks.
Please welcome Dara Khosrowshahi, CEO of Uber, and Ben Smith, co-founder and editor-in-chief of Semaphore.
Thank you so much. Thank you for joining us, Dara. We will get to the question of how I raise my Uber rating at the end of this, but first, I guess, big question: what is Uber's role in the transition to autonomous, to self-driving? You're going to own cars? You're going to build cars? What's the plan?
Well, I think the first role that we play is to help with the autonomous ecosystem in terms of commercializing the business, right? Right now, the technology is advancing at a substantial pace, and I think in terms of safety and establishing superhuman safety, while a Waymo is absolutely there, some of the competition is starting to get there as well. There's a lot more to autonomous that needs to happen in order for it to happen at scale. You need a consistent regulatory environment, and the DOT, for example, released a position that we think is a very good position, makes it, create some consistency on a national basis. We're very much for that. You need on-the-ground operations, right? You need depots and cleaning and recharging, et cetera, to operate these cars on a local basis. You need affordable hardware costs. Right now, these cars cost hundreds of thousands of dollars. You've got to bring them down to tens of thousands of dollars. And last but not least, you've got to drive utilization of these cars, because this is incredibly expensive technology and incredibly expensive vehicles that you've got to make profitable over a period of time. So we essentially are helping the ecosystem amongst all 5 of those needs. And really, just like we want the best and safest human drivers on our platform on Uber, we want the best and safest robot drivers on our platform. If I think you were in Austin and you took an Uber and Waymo showed up. So right now in Austin, if you choose an Uber, you will get dispatched sometimes a Waymo. Same will be true in Atlanta, and in other cities you'll see the same.
And for me, I definitely concluded that I was just to overshare. I was on my way to a funeral and had a private phone call to make about that, and was happy to be alone in the car making a call to my wife. And it was definitely a superior experience. I also just learned from you that apparently drivers don't like it when you're just yammering on the phone the whole time, which is why I have a low Uber rating.
Why we think you have
might
a
be
low
something
Uber rating.
else.
Yeah.
But is autonomous basically a superior product? Is the sort of Uber driver a temporary phenomenon?
So I think if you fast forward 15, 20 years, I think eventually the cars are going to be autonomous. And that's not just true in Uber. I think generally on the road, there's very strong evidence to believe that robot drivers are going to be safer than human drivers. They're not going to get distracted. They're not going to get texted, et cetera. And basically, this software is learning, is getting retrained every single day based on the world as it is. So they will be safer, right? And there are more than 30,000 fatalities, automotive fatalities in the U.S. every year. Around the world, it's more than 1 million.
How many robot fatality? I think there's a belief that people are more comfortable with human-created fatalities than if a robot kills you, even if that's irrational. Do you have in your head a ratio? Do you have to be 5 times safer, 10 times safer?
I think it's gotta be approaching the 10x safer. Humans understand that humans are fallible. They're not okay with software, in the world of AI being fallible, or certainly these mistakes happen on the road. So I do think that superhuman safety is an absolute prerogative in the business.
Elon Musk seems to think that Tesla can dominate the robotaxi business without Uber. And that they have a huge brand. He has a huge media network. Do you think that's right? How worried are you about that?
So I don't think that there will be a winner take all. The drama is winner take all, but I think that the transportation industry is $1 trillion+ industry. You could argue that rideshare is going to be finally beat personal car ownership in a world where you've got robots driving all over the place. So I think there'll be plenty of room in the industry. We'd love to work with them. But I do think you're going to have multiple players. Some of them are going to go direct, and some of them are going to go through networks like ours.
Do you own a car?
Yeah.
What is it?
I have a Tesla. Great car.
Have you tried full self-driving?
Yes.
What do you think of it?
It is delightful, but I have to take over every once in a while. It is an absolutely great product. And again, the car is a terrific car.
Tesla, a bit of a meme stock, has been trading between $200 and $450 a share for a while now.
I'm not a Wall Street analyst.
Quite up and down, so. But if what you say is true, that basically ultimately cars are cars, that it's kind of a tough business, at what price point would you buy a share of Tesla?
I have no idea. I own the car. I don't need to own the stock.
But by your theory, that company is wildly overvalued. Basically, is that what you believe?
No. I'm not saying that. I'm just saying that there won't be a winner take all. The market is too large for
But
there to be a winner take all.
they're valued as though they are winner take all, though. Basically,
I think that they're valued based on both autonomous and robotics, et cetera. But I'll leave up to the Wall Street analysts to value.
There is this sense that Elon is like pivoting hard from cars to robots. That he's gotten a little bored with cars. Would you encourage that pivot?
I don't know. I can't speak to whether he's getting bored with cars, but the OEM business, the traditional car manufacturing business, is a really, really tough business. In order to achieve scale, you really need to sell globally. And if you're going to sell globally, you're going to have to compete with the Chinese auto manufacturers. And the Chinese auto manufacturing sector has made extraordinary advances over the past 5 to 10 years.
And you partner, I think, with Pony among the Chinese.
We've announced a partnership with WeRide. We have WeRide, which is an autonomous player, terrific team. We offer WeRides now in Abu Dhabi, and we announced an expansion into Dubai as well. But if you're just a traditional manufacturer of cars, you will have a very, very tough time, and especially EVs, you will have a very difficult time competing against the Chinese EV manufacturers.
I mean, there is a sense from anybody who comes back from China anywhere near that business, I think that the U.S. car industry, and the technical term you hear used often is cooked. Is that your impression? Like, are we going to be France, where maybe we can get some people to drive Peugeots and Renaults domestically, but basically it's over? Or are we going to be the Soviet Union, where everybody has to drive a Lada?
I think right now, especially as it relates to EVs, right? Almost 50% of Chinese cars sold are EVs.
Yeah.
The scale that they've achieved, the quality that they've achieved, the battery technology is ahead of what I've seen in the U.S. Doesn't mean the U.S. can't catch up. Never count out the U.S. But right now, the competition in EVs is extraordinary, and right now the Chinese are winning.
Do you think that these tariff policies, as proposed, can help the U.S. catch up? I mean, are they going to be effective?
Well, I think tariffs in some ways are designed to protect local manufacturers, right? The issue with tariffs is that sometimes that protection removes the need for vicious competition. And vicious competition is that is what gets you to be best of breed. So if the tariff policy results in companies who have it easier and rest on their laurels, no, it's not going to work. Then you will have, call it a Peugeot, et cetera. I've got more faith in our U.S. OEM partners than that. So I'm hopeful that they can use this opportunity to push to be as competitive as we expect the U.S. manufacturing sector to be globally.
Obviously we're in Washington. Everybody's trying to figure out what the administration is doing. The Trump FTC recently went after Uber over a kind of pricing question. Did you think, I should have written a bigger check to the inaugural committee or whatever?
Honestly, that one was a head scratcher. It had to do with our Uber One membership program and signing people up to it and canceling. And for example, there are claims that it's difficult to cancel, and we make it incredibly easy to sign up for Uber One. The value is enormous. The renewal rates are over 90%. It's a great product. And we allow you to cancel, we allow you to pause. So we'll see, we'll get into the details, but that one was a head scratcher for me.
But is there anything that makes you optimistic about this administration's policy, particularly toward AVs?
Yeah, I think that certainly what we are seeing coming out of the Department of Transportation and the idea of a more consistent regulatory framework that has safety considerations first, but then competitive considerations and thinks about kind of the global ecosystem, I think that is a reason for hope. And I do think that as an industry, I do think that we have been overregulated, and not just our industry, many, many industries.
Yeah.
So lighter, more consistent national regulatory framework across many areas is something that I think could be very, very helpful.
And do you think that, can you give us a sense of, in this, I think there, it sounds, the Transportation Secretary was here yesterday.
Yeah.
Clearly very engaged on these specific questions and very knowledgeable about them. Do you like? Can you give us a sense of when are we going to see? Because I just when I was kind of blown away in Austin that I opened the Uber and got a Waymo. Like I was very pleased.
Yeah, it's awesome.
I wanted to try one, but was too busy talking on my phone to download the Waymo app. But the
I hope you got a good rating from the driver.
The robot driver. Do they rate you too?
I'm not telling.
Oh God. But can you give us a sense of when we're going to see, when I'm going to be seeing experiences like that here in Washington and New York and our big East Coast cities?
It all depends on the regulatory framework. So
Yeah.
I do think that you're going to see, obviously in Austin next year, we will have hundreds of Waymos available on Uber, and it's just a great experience. It's a delightful experience. You felt it yourself. In Atlanta, there will be hundreds of Waymos as well. But the expansion really depends on the local regulatory framework. And right now, I'd say California and Texas are the most open market, so to speak.
And you don't anticipate the feds totally steamrolling the local, sort of overriding.
I don't think so. That there are certain, as it relates to manufacturing standards, I think it's entirely appropriate for the federal government to step in. But I think local regulations of what these cities and states expect on their street, I think that should stay local.
One of the sort of long-term questions about whether certain urban areas are difficult because the pedestrians are basically so aggressive and will take advantage of automated vehicles, and just walk, just totally force them.
It's an elevator problem, right? You see doors closing, you put your hand.
Yeah, exactly.
Right? That's not
incredible.
That's trained behavior. Yeah.
Do you think? I don't know. I mean, is that going to be a medium-term problem in New York, or do you think norms change and we're not that bad?
I think it is absolutely going to happen, but I think that the autonomous and AI technology that we're seeing will be able to adjust. I'm not saying that it's a small problem, but you will see that the AIs now are acting in much more human ways. They'll edge into, if they're taking a left turn, they'll kind of edge into the lane. There are a lot of verbal cues that human drivers get from human drivers.
Right.
Visual cues, right? In addition to blinking, et cetera. So you will see autonomous drivers who drive more and more like a super safe human.
I once had a New York cab driver tell me that the trick when a person is walking in front of you is just to aim right at them, so that they don't get confused. So maybe they'll learn these.
I don't want you. I don't want you training my AI.
You also, obviously you're in the labor, you're across the labor market in a really interesting way, and I think Uber's, if there is an economic downturn, which a lot of people think will happen, you obviously, like any consumer-facing company, people might use the service less, but on the other hand, if unemployment goes up, people start driving for Uber. Is that right?
Yeah, we are the way I term us is we're recession resistant, which is both the revenue side and the cost side of the business flex up or down based on GDP. So in a weaker economy, if there is more unemployment, the cost of Uber will come down because to some extent the cost of labor comes down, and that will keep unit volumes at decent volume. So we tend to be resistant to recessions generally. And if you look at the food category, restaurant category, groceries, and transportation, in recessions, those categories actually suffer the least, so to speak, because they're everyday use cases. You may put off going on vacation in Europe this summer, but you're still going to treat your family out to a nice dinner. So these are, we specialize in small treats, not big treats.
That's exactly actually what the CEO of Philip Morris International told me this morning. Zins are apparently also part of that basket. But just to finish up, are you seeing anything? Are you seeing flickers of a recession in your, I guess, either in your rider data or your driver data?
No, not at this point. I mean, when I watch CNBC or when you read the paper, certainly the prospective news is not great.
Yeah.
But when we look at our business, the day-to-day habits of consumers around the world look pretty consistent to what we've seen for the past couple of years.
Well, thank you so much for doing
this. Thank you.
Thanks for joining us.
Appreciate it.
Ladies and gentlemen, our next session will start in approximately 30 minutes. Thank you.